quickly on inflation rate. How concerned are you about it?
I'm significantly concerned about it because the amount of money and credit that has to be produced and is budgeted is a large increase. And yet, if it's not spent, it produces its own problems. The markets have a sensitivity to that. So what it means, and then there's a supply-demand picture for bonds. And the way it looks is if you should get the selling of bonds, it worsens that supply-demand picture, because the way it works is the Treasury borrows and runs a deficit, but it can't produce money. So it has to sell bonds. And when it sells bonds, if there are not enough buyers of those bonds, then the Federal Reserve got to come in and print money and buy those bonds. And the world right now is over invested in US dollar denominated bonds, pension funds on the 60-40 mix, and they have negative real returns. And cash has a lot of negative real returns. So if there was a selling of that and a moving to other assets, stocks, other assets, commodities, other assets, or other places, other currencies, other real estate and the like, that selling worsens the supply-demand picture. And then if there's not enough demand, that means that the central bank has got to come in and print more money. So yes, it's not only the inflation that's in the pipeline or projected in that supply-demand balance, but it's also what it could be if there's a selling of debt instruments.
Inflation is once again in focus, but of course it has been in focus, and that intense scrutiny has really been ratcheting up and also figuring into a lot of the outlooks as we look into 2022. And in fact, Bank of America, is one of its notes looking ahead to next year, notices how many times inflation has been mentioned in its own notes and how much more frequent that has become. Jared Woodard is with us now, head of the Research Investment Committee at Bank of America. This is the very first chart in your note, Jared, and I think it just kind of summarizes it, right? That we've just, yes, the numbers have been important, but we've also been paying so much more attention to this. How big of a problem is inflation going to be or not in 2022?
Well, Julie and Brian, it's good to be with you. And I think you're right. The inflation is kind of all anyone's talking about sometimes. And it's certainly on the minds of our analysts, as you mentioned. It's on the minds of the Fed. It's on the minds of our strategists and economists, and certainly investors, most importantly of all. I think the most important question for investors in 2022 is how serious is the inflation problem? How serious will the Fed response be to it? And how serious will the market reaction be? In other words, should you change your portfolio allocation today in advance of Fed hikes, in advance of ongoing inflation? We think that the answer is yes, to some limited extent, because we expect the Fed to raise interest rates 3 times next year. We expect them to take a more hawkish tone in terms of communication and the pace of tapering. Some of that you might get, at the meeting and the communication today. And we think that as a result for investors, it's a year in which equities may be more volatile, might be more choppy, a year in which government bonds and even high quality corporate bonds might see negative total returns. It's also a year, we think, in which there are better opportunities elsewhere in the financial market, whether it's in credit markets, high yield corporate bonds, for example, even some emerging market debt, or in equities, other parts, away from tech, away from large cap stocks, maybe looking at small caps or mid caps where there's better opportunities than you might see in some of the headline names.
Jared, your team is looking for a rate shock. What is a rate shock? When does it happen? And what happens to the stock market if we should get that rate shock?
Well, historically, when interest rates rise and the Fed is raising rates, it's kind of the end of that hiking cycle. They tend to hike until the market breaks, as it were. This cycle may be a little bit different because in the last 10 to 20 years, the Fed's been primarily concerned about addressing unemployment and raising interest rates only until they start to see pressure in the job market. Well, this rate cycle, as it proceeds, we expect to be very different because the Fed's concerned much less with the labor market, where things are improving, pretty quickly, much more with fighting inflation, as we mentioned. So the risk from our view at B of A Research is that the Fed's going to be keeping both eyes on inflation. They're going to be hiking aggressively to stem those pressures, and that could cause more pain for financial markets than we've seen in the last several hiking cycles when labor was the big issue. What that means for investors, again, is that positioning a portfolio in advance of those rate hikes and certainly keeping cash on hand to take advantage of market dislocations is probably the best way to approach what could be a very unusual year.
Jared, do you think the Federal Reserve short circuits the business cycle?
I don't think they will. I think if there's any sense that the market's becoming, disoriented, if there's any sense that the Fed's tough love is becoming a little bit too tough, I think that they'll pull back the way that they have, in their long history of being responsive not just to the underlying economic data, but also to financial market conditions. There's a lot of debate on Wall Street right now happening about where is the Fed put? How far would you have to see markets sell off before the Fed would take a more dovish tone? That debate will probably continue next year. We don't know that there's a definitive answer. What we do know is that the Fed looks at gauges of financial conditions and market liquidity, and if the communication that they pursue, if the pace of tapering or even the pace of the rate hike path becomes a little bit too extreme for the market to digest, then we expect that interplay to resume again. That's why I say investors should be prepared not just to allocate capital away from the rate-sensitive, Fed-sensitive parts of the market, but also to have capital ready to deploy in case the Fed does get a bit too hawkish and cause a market correction.
Jared, it's so funny to me because there is this sort of irony here. It feels to me like market participants have been putting pressure on the Fed. They think the Fed's been behind the ball on this, right? And yet, okay, so now the Fed is doing what the market wants, for lack of a better word, but the market might sell off sharply on this, right? I mean, and this is not unusual, but it is sort of ironic, isn't it?
I think it is. I see your point. I mean, individually, market participants can be rational. Collectively, they can be, a bit schizophrenic. So I think that there's not any one thing that the market wants. What a lot of investors want is a Fed that's clearly alert to inflationary pressures. They also want a Congress and administration that's alert to those pressures and can take action to address them. Sometimes people ask me, investors ask, well, what will increasing, interest rates do to the lack of semiconductors for autos or to the delays at the port, in California? Not clear all the time what the relationship is between those two things. And so I think that the Fed's alert to that as well. And that's why they want to communicate clearly and effectively what they hope to accomplish. If they can do that and persuade investors, then actually the market can hopefully digest some of these changes pretty smoothly. The risk would be if the Fed was prepared to sort of steamroll ahead in the absence of a clear rationale, then you might see a bit more market gyration as investors, doubt the rationale for their path.
Right, definitely. So we should be paying a lot of attention to how Chair Powell communicates this afternoon for sure and how the market reacts. We've been talking about the markets. I want to talk about companies for a minute as well, because you talk about that in your note too, and cash deployment, which I thought was quite interesting. The different ways that you guys expect companies to spend their cash in the coming year. And what should be our takeaway of these different ways that they're going to be spending this cash? The fact that a decent amount is on CapEx, is that a good thing, a bullish thing for those companies that are doing that?
Well, I think it is. I mean, to back up for a second, when we look at the balance sheets of companies across America, they're sitting on more than $7 trillion in cash. That's a record high. Some of that has to do with stimulus over the past year and a half. Some of that has to do with the success that they've had, in their own businesses and profitability. But that record mountain of cash, at some point we think is likely to be deployed. There's essentially kind of two debates for next year. Will companies continue to sit on that cash in a more defensive posture? If they do that, we think that those credit-focused, parts of the fixed income market, high-yield corporate bonds, leveraged loans, even emerging market debt, are likely to be big winners. If companies do deploy that cash, there's a few places they could go, and there's investments that we write about that I think are attractive in each case. They could pay out buybacks and dividends, return capital to shareholders, in other words, in the absence of other opportunities. And we know in that case, there's some high dividend companies, high dividend ETFs that we cover, financials that could benefit, other kind of sectors that are big buyback participants. If they get a little bit more bullish and they go on a round of M&A to merge with other competitors and build up their business, or they engage in CapEx on their own terms to grow. That's probably the most bullish scenario of all. And there I think you see industrials, you see other parts of the cyclical sectors that are going to be big winners. The debate about what companies do with all that cash, where they deploy it, and what the timing is I think the most interesting question for next year. The big takeaway for us is there's almost no scenario in which corporate America starts to engage again that isn't bullish for the market. The real question is which opportunities are going to be the best ones to take.
The first week of November was about $15 billion per month. The Fed will now double that to $30 billion per month, which would put an end to the so-called quantitative easing program by March of next year. Now, there's a lot to unpack in this Federal Reserve announcement, a lot of language changes. The big shift really to a faster taper has to do, of course, with inflationary pressures. The Federal Reserve no longer describing inflationary pressures as transitory. Instead, the statement says, quote, supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to elevated levels of inflation. On the job front, the Fed described job gains as, quote, solid in recent months, and the unemployment rate has declined substantially. Now, what's interesting is that the Fed did say that risks to the economic outlook remain, including new language that says this includes new variants of the virus. Now, the Fed is also trying to balance its approach to tapering alongside its reaction function to eventually raising interest rates. And those that are in the know that this Fed announcement also came alongside a set of economic projections, what they call the summary of economic projections. If we unpack the dots that are in there, which map out the 18 members of the FOMC and where they see interest rates going in the next few years, notable to see that none of the 18 members of the committee see the case for holding interest rates at near zero through the balance of next year. Instead, the median member of the FOMC now sees the case for 3 interest rate hikes by the end of next year. So certainly a much more aggressive Fed than what we had seen telegraphed in September, where you'll recall 9 members of the committee saw the case for no interest rate hikes next year, but the other 9 saw the case for at least 1 interest rate hike. If you look out to 2023 and 2024, you have a number of other possible interest rate hikes as well. In fact, if you actually look at the 2023 projection, the median member sees another 3 to 4 interest rate hikes that year, with another 1 or 2 in 2024. And also, a lot of this is because of those inflationary pressures. The projections in the SEP have the median member of the FOMC projecting 2.6% inflation as measured by personal consumption expenditures. That's a notch up from the 2.2% that we had seen in the September projections. So there's a lot to unpack in this statement. One other thing that's worth noting with regards to the framework, the Federal Reserve actually changing its language with regards to its announcement that it was going to hold interest rates at near zero in this particular meeting, which was expected. They said the committee expects it will be appropriate to maintain near zero rates until, quote, labor market conditions have reached levels consistent with the committee's assessments of maximum employment. So the Fed really trying to put the pedal to the metal on the idea the labor market is going to tell them when to raise rates. But again, the big headline, Fed doubling the pace of the taper, none of the 18 members of the committee seeing the case for holding interest rates at near zero next year, guys.
Brian, it's Adam. Quick follow-up, and it's not something the Fed would answer to, but I imagine Jay Powell might get asked about this. President Biden's going to be appointing new members to the Fed next year. We're going to have new presidents at some of the Federal Reserve banks. How likely is it that the dot plot will change at the next summary of expectations release in March?
Yeah, well, certainly when it comes to the kind of composition of the Fed, in fact, even before we got those announcements, we already knew this committee was going to look very different. First of all, we have 2 regional Fed presidents in the Dallas Fed and in the Boston Fed who were temporarily replaced because of the trading scandal we had saw engulf a number of Fed officials a few months ago. Now, that aside, we also have some departures that are regularly pre-scheduled. Randall Quarles, whose term as vice chairman of supervision expired in October, will be leaving at the end of this month. I believe this is his last meeting. And then Richard Clarida, the vice chairman of the Fed itself, will be leaving in January of next year. So there's already 4 officials right there that could be turned over. And then you also have those vacancies at the Fed itself, which the Biden administration could fill in. At least 3 they could fill in. Of course, we don't have those names quite yet. The administration had promised to nominate people before the holidays. So we'll see. They only have a few more days left to make those announcements. But the composition of this Fed could indeed change. And that means the dots themselves could change because, again, each of those 18 at its max, actually 19 members of the committee get to plot out where they see interest rates going, if you have at least 4 people turning over next year, that means that those dots could certainly move next year. But of course, we only get these projections on a quarterly basis, which means the next time we'll get a read will be in March. And as you mentioned, Adam, the Fed could look very different by that point in time.
And we want to continue the discussion with Michael Gapin, Barclays chief U.S. economist. Michael, great to see you here. Always great to see you, especially on Fed Day. This is arguably a somewhat hawkish report, but we're seeing risk markets rally. What are you making of this?
Well, thank you for having me on. It is always fun to do this on Fed Day. I think probably what the market is reacting to is the cumulative number of hikes that are in the median, 3, 3, and 2, so only 8. So leaving the funds rate short of where most on the committee think is neutral by the end of 2024. Perhaps the concern was that the Fed felt it was far enough behind inflation that it would need to put the terminal rate above the neutral rate, over tighten to bleed out some inflation and inflation expectations, which would have been a negative for risk assets. So if I had to guess, it's probably more about the terminal rate than it is about the pace of hikes between now and 2024.
Michael, for investors, if we're looking from now until the next meeting in March when we get the revision of the summary of economic projections, in real world terms over the next 3 months, what does the tapering speed up mean for me as an investor?
I think that the way that I would frame that is that the Fed said coming out of its November meeting, it said this in the minutes, it said risk management is now the guiding principle in the conduct of policy. So tapering isn't so much about whether we buy a few $100 billion more or a few $100 billion less. The Fed's already purchased about $5 trillion in securities. That's rounding error on what the Fed holds. I think it says something about the Fed's willingness to move to rate hikes. So I think in a risk management world, where we're responding to risks around inflation as much as where inflation is currently, tapering faster says something about a willingness to move to rate hikes. And I think that's how investors need to absorb it. It's not so much about whether we're buying, whether purchases finish in mid-March or mid-May. I think it's more about the willingness and the desire to remove accommodation going forward.
Would that mean liftoff in March?
Well, that is actually our baseline. We were coming into this meeting thinking 3 hikes next year and a hike in March. So the statement actually leans in the outcome today so far leans in the direction that we're thinking. Certainly the Fed could get in 3 hikes, hiking in June, September, and December. So it's not obvious that it has to be March. But read what the statement says. The statement reads as if the Fed has already declared that it's met its inflation mandate. It says inflation's running well above 2, and the unemployment rate has fallen. And when the unemployment rate reaches maximum employment, then we're going to lift off. So that could very well be March. The unemployment rate is 4.2. The statement says it has fallen substantially in recent months. So we suspect if that progress continues, the Fed could find itself in a position where a March liftoff becomes appropriate.
This is certainly, a big pivot from the September decision that came out. And so I'm wondering, how careful does Fed Chair Powell have to be in his comments coming up in a little bit to make sure that he navigates this just right?
I think the way that I would respond to it, you're exactly right. It's been a very big pivot. It's even been a big pivot since the November meeting. Remember, he was doubling down on transitory at the November meeting. So in just a few short weeks, it's been a big change. So the way I would say it is this. The Fed is willing to surprise markets on cuts or easing policy. It doesn't want to surprise when it's tightening. So and faster runoff and obviously pulling in the dot plot is a form of tightening. So the Fed was clear. He was very clear in his messaging in front of Congress. He repeated it. I suspect you will hear him repeat that today. So today is all about, in my mind, completing that hard pivot and coming out of today's meeting, sending the message, we think we're there on inflation already. It's about waiting till the labor market gets to full employment. We're ready to transition from tapering to rate hikes next year. And in the market, as I think your prior guest said, the market's already pricing a lot of this in. So this is really the Fed coming around to where the market is. And I think the chair shouldn't leave wiggle room. He should complete the pivot today when he speaks at the press conference. Yes, Omicron's a concern. Yes, there's uncertainty. But I would say don't back away. Just deliver the message. The market is already there. And then I think things will be fine. And you can wait to see how the economy evolves.
And Michael, we're talking about 2022, but we don't even know what the composition of the Fed is exactly going to be. We know Chair Powell is going to remain the chair, but we have a number of Fed officials, some of whom are leaving under inauspicious circumstances. What does leadership look like at the Fed next year? And what kind of a headwind is it, the fact that we don't know exactly who's going to be at these meetings sometimes?
Yeah, that's obviously there's a lot of turnover, and you make a very good point. I would just remind people that dissents within the Board of Governors are rare. So if it is indeed Powell delivering this message, and this is the course in which the chair wants to go, the chair and the vice chair, Powell and presumably Brainard, will both be confirmed. If this is the direction the leadership wants to go, I would suspect the new appointees, particularly on the board, would support it. So I'm less concerned about that, but you're right, the names are going to change. And we need to hear and see where those people are. But this seems to be a clear shift, a clear pivot. And I would say the divisions within the committee have now been resolved in the direction of removing policy accommodation sooner than later. So I think the trajectory is there, and we should listen to that.
I want to get a quick check on the markets because they are reacting to the decision that came out. So if we look quickly at the three major benchmarks, we can see that we pull up those numbers. The Dow is now up by 133 points. The S&P also up by 20 points. The NASDAQ also in positive green territory, up 40 points, all at session highs on this news. And with more on market movers on this decision, let's turn it over to Yahoo Finance's Ines Ferre. Ines, what are you watching?
A close look at what happened with the markets when that Fed decision came out. Take a look at the Dow Jones Industrial Average. So you saw a little bit of a knee-jerk reaction to the downside, just a tiny bit, but then shot right back up. So right now, as you're mentioning, the Dow up 0.3%. The NASDAQ, same type of movement right here, and the S&P 500 as well. Taking a look at the 5-year T-note, we are watching that go higher, up 5 basis points. Also, the 10-year T-note up 3 basis points, and the 30-year bond, taking a look, it's up 2 basis points. Also want to mention the U.S. dollar index because we've seen that shoot up. It was up about 5 basis points before that decision came out. It's up about 22 basis points now. And then looking under the hood at where we're at with stocks, we are watching these sectors which you had seen, utilities and real estate, some of the defensive sectors higher this morning. They are still higher today. But the losses here, pairing some of the losses that we had seen in some of the other sectors that had been lagging earlier today. So just looking at the NASDAQ 100, we watched some of these mega cap names flip into green territory. Apple up 0.7%. Check out the movement here from after the decision came out. Microsoft also in green territory, as well as Facebook. And then just looking at Bitcoin, we have been watching the cryptocurrency space. Bitcoin, Ethereum, these higher as well after that decision.
Here with his take on what we can expect and how markets are reacting is Alfred Iskander, Salt Financial President and Chief Operating Officer. Thank you so much for being with us today on this important day. Just want your sense of what you make of the markets ahead of the decision today and the retreat that we've seen over the last couple of sessions in equity. Is there some repositioning that's been going on?
We believe there certainly has been, and we had picked up some elevated vol going into this week, as we've seen for the last couple of days, with 2 sessions of down days as the vol has been elevated. This is a very important meeting, as we all know. There's only 12 trading days left in the year. And if you think about it, it's probably the only real catalyst for any major move one way or the other before the year is over.
And Andrew, just thinking about market participants looking for an end of the year rally, so-called Santa Claus rally, typically happens, but it doesn't always. You think back to 2018 when the Fed was front and center yet again, and they probably committed a policy error by raising rates too many times, and the market sold off precipitously after that. I'm just wondering, what are the odds that we have a repeat of that same situation where markets don't like the hawkish tone of the Fed?
It's a great point, and we could easily have a repeat of 2018. If you recall, after I believe it was the December 19th meeting, the market traded down 5 days in a row, giving up almost 8.5% of returns. So that is likely. What we've seen so far is the Fed has changed its tone. It certainly has become more hawkish lately. But also, you got to take into effect the fact that we've had a tremendous year. We've had great returns, and there's an incentive almost for the Fed to just kind of rip the Band-Aid off, because even if you have a similar repeat of 2018, you're still going to finish the year in double-digit returns, which helps really reset portfolios for 2022.
I wonder, what sort of volatility do we see in the first half of next year, given that there is going to be this tightening that goes on, and what assets are most vulnerable to it?
Yeah, so Karina, that's a great question. And what we do is, when talking to advisors, is really get into the portfolio overall and try to understand how sensitive is it to shocks like this, or potentially, even greater volatility going into the new year. And if you think about it, there are more things than just stocks and bonds. I mean, there's other innovations that have happened in the market in the last 10 years that really help long-term investors cushion that volatility, protect income. And I'm talking about products ranging from fixed index annuities to structured products to even some of the most easily attainable, which are, buffer ETFs. So I think it would be, a service to investors to talk about and learn about these products, because they do offer a certain diversification that simply bonds don't offer right now. And if you're thinking about protecting income, I don't think anyone's telling you to run in, with both feet into fixed income.
And I got to ask you about your outlook for inflation as it affects all asset classes and risk markets. What do you see happening? I think the transitory thing is out the window. Even Powell says we're not talking about that or using that terminology anymore. But at what point does inflation peak, do you think, in the coming year?
Well, inflation is real. I mean, I experienced it last night having dinner in the city at a very well-known restaurant where the prices seemed a little bit bigger. And had a little technical issue with the credit card, but otherwise, it's just more expensive, and there's no way to avoid it. We just saw the CPI with a 6.8, handle, and that's real. People do feel that. Whether you're out to dinner or you're in the supermarket, there's no way to avoid it. I don't think it goes away anytime soon, especially with the spending bills that we have. But again, I go back to volatility and understanding how you're positioned for 2022. We've got elections coming up. We've got Fed decisions. There's a lot of things going into where investors really need to focus on volatility, how to protect income, and how to diversify, not just with stocks, single stocks and bonds, but with other more innovative products that will actually behave the way, a portfolio manager would behave. And these products do exist. And I urge, advisors to teach their investors about these things because, we do have an unbelievable array of products when put together correctly will really give an investor, certainly for the long term, a much easier way to sleep at night.
Let's bring in Danielle DiMartino Booth, Quill Intelligence LLC CEO and Director of Intelligence. Danielle, you saw Brian sort of lay out the case here. Certainly the market anticipating this accelerated taper timeline. How aggressively do you think the Fed needs to move?
Well, I think the Fed needs to be more measured than it's being pressured to be, and specifically pressured by politicians. So we have to remember that Jay Powell has been one of the most active Fed chairs in the history of the institution in terms of how often he's up on the Hill and how many people in Congress that he's visited with in the meetings that he's had. So he's feeling tremendous amounts of pressure to try and attack this 39-year high in inflation. And you actually, if you're looking specifically through the prism of goods inflation, durable goods items that we buy, you have to go back to 1942, not back to the 70s and 80s. You have to go back to 1942 before you can find other inflation prints that have been this high. And of course, that was a time that we were at war and there were major supply chain disruptions for other reasons. But again, this is very problematic. And I think he's going to have to listen to some of the voices in Washington. And to Brian's point, are we going to see the Fed chair who we saw in 2018? And in December of 2018, he was very upsetting to the markets, and we forget that. This is prior to the Powell pivot.
Yeah, Danielle, I mean, as a former Fed official yourself, it's pretty interesting the timing of all this too, right? And it's probably the worst possible scenario to be coming off of a dovish stance when you've got Omicron and now cases in the UK hitting a daily record. I mean, that's a big unknown. And so even though the market might be anticipating some of these things, it's still a large question mark in terms of whether or not now is the time to be shifting a policy stance. I mean, how difficult is that for anyone at the Fed, whether it's Powell or not, to ever manage a decision like that?
I do not envy Powell at all. I don't envy the individuals on the committee. I would hate to be having to put my dot on the dot plot today, especially on the day when retail sales come out and we hear that core retail sales, if you exclude building materials, autos and gas, actually contracted last month. I mean, that's the last thing you want to see. Even if you want to argue that a lot of the holiday shopping was pulled forward into September and October, even so, you don't want to see a negative print on retail sales while you're anticipating a rate hiking cycle possibly, and you've got a lot of hawkish members rotating into voting in 2022. So Powell's also dealing with the specter of not one, not two, but possibly 3 and 4 dissents at any given meeting if he's not willing to accelerate the pace of the tightening.
Danielle, there is a question about, whether in fact the market expectations match where the Fed actually is. We've had a few weeks now to sort of think about that testimony from Jay Powell, where he said he was essentially retiring the word transitory. You've highlighted the expectation right now is for that first rate hike to come in March. Do you think that's justified? If you look at where things are in terms of the trajectory of the economy, should that rate hike come in March or potentially be pushed back a little further?
Well, it's hard to say because of the rapidity, and I don't mean to get in the weeds here, but how quickly the yield curve is compressing is very problematic for the Fed. And that tells you that they may be running out of time. So the difference between the 2-year Treasury and the 10-year Treasury, which is something that we spoke about for it seems like an entire year in 2019. That is problematic all over again. We've seen it go from 160 basis point, 1.6 percentage points to 80 in the space of 6-7 months. That's the fastest we've ever seen the yield curve compress. And I would hate to have to be Jay Powell and say, come March, the yield curve might even be inverted. If the market begins to anticipate too much tightening, and you're stuck in between a rock and a hard place, proverbially speaking, because you cannot hike interest rates when the yield curve is telling you the economy is going into recession. So, you're right. There is a differential here between what the market is anticipating and what the Fed may be able to deliver.
There is maybe one improving piece of this recovery, and we've seen it kind of continue to play out. It is the declining unemployment rate. And on that front, I mean, there are a lot of questions about people maybe retiring early, dropping out of the labor force, and how big of a swing factor that is and really seeing that rate go down. But I mean, when you look at maybe the labor side of things and wage pressures for increases there, still not really living up to the rate of inflation. So, I mean, when you kind of step back and look at maybe the health of the U.S. consumer here across different income spectrums, what do you assess in terms of how that piece of the recovery is shaping up to be?
Well, I mean, look, we don't talk about it as much because there's no more supplemental unemployment benefits and there's no more rental eviction moratorium. But there are still some very significant sources of fiscal stimulus that are helping out the lowest income earners right now. And what happens in 2022 as we turn our eyes towards the midterm elections and moderate Democrats such as Joe Manchin, John Tester of Montana, Sinema, it becomes very important whether or not this fiscal relief is going to continue in monetary form, like in cash deposits into the new year. If that's not the case, and we're seeing retail sales slow, again, it's a very difficult situation because the consumer has been the source of strength throughout this cycle in the post-pandemic era. Housing has been very strong. Auto sales have been very strong. But, auto sales are off 7 of the last 8 months. At some point, you cannot ignore some of the red flags that are being raised by the consumer when consumption is 71% of U.S. economic output.
Let's talk more about the fiscal side then, because as you know, we have seen President Biden getting hit pretty hard as we see inflationary pressures tick up. He has argued that they've tried to move the shipping along at ports. They've tried to essentially they did release from the petroleum reserves to try and bring gas prices down. But I'm wondering, as we talk about the monetary side of things, what more do you think needs to be done on the fiscal side?
Well, I'm actually with Joe Manchin in saying that we need to step back and reassess what fiscal spending has done, past tense. We had a 32% increase in supplemental nutrition assistance in the assistance program, which we used to call food stamps. We had a 32% increase on October the 1st. That's the biggest increase in the entire history of the program. We've never seen anything this monumental, and it's feeding straight into food inflation, which very few people talk about. And these are critical. We're talking about the most essential budgetary items for consumers, and a lot of this lays at the feet of fiscal policy that's become too aggressive. And it's actually creating inflation that is the most regressive tax for the lowest income earner and the middle income earner as well, that is not that does not have access to a lot of these government benefits. So I'm of the opinion right now that we need to take a pause when it comes to fiscal stimulus and step back and say, what if fiscal stimulus and monetary policy are feeding off of each other and exacerbating this inflationary situation that we're looking at?
We want to continue the conversation with Sarah Howe. She is a Wells Fargo senior economist, and you've been listening to our commentary here. What's your initial reaction to this report here?
Well, I think we've seen the Fed finally get concerned about inflation. So we see that with the upward revisions in terms of the summary of economic projections, both in terms of those inflation forecasts, but also, of course, those moves in the dots. So I think they've come around to the view that we are going to see these bottlenecks persist, and that you have seen this tremendous demand that's going to take some time to cool off, and will probably take some somewhat tighter policy, in particularly in areas that are interest rate sensitive.
Hey, Sarah, it's Adam. I want to get back to this concept of purchasing power. The steps they took today, is it really going to take 2 to 3 years to see that really materialize? Or with the dollar going up in value just by an announcement that tapering will be faster, doesn't that help me as a consumer and as an investor?
I think given the inflation that we're seeing today, the impacts of the dollar are going to be pretty limited. So, you have to remember when we think even in import prices that most contracts are already priced in dollars. So I think the efficacy there is limited. I think so much of this comes down to the overwhelming consumer demand that we've seen in the wake of the COVID pandemic, and just the issues with supply chains and manufacturing globally, keeping up with this, creating this inflationary bout. And so I think it is going to take some time to essentially normalize these patterns, and with that, some tighter policy.
And I wonder, from the announcement, it says job gains were quite solid according to the decision. How close are we to full employment? And do you think the Fed has abandoned that part of the mandate to some degree to focus on inflation?
So I think they are giving more weight to inflation right now, given that it's what's really out of bounds with its goals. And the fact that we have seen this improvement in the labor market allows them to focus more on the above target inflation. So they're not having to weigh one versus the other quite as much. But given the fact that we have seen the labor market tighten tremendously, even in just the past few months. So over the past 3 months, we've seen the unemployment rate drop a full percentage point. I think that has allowed them to focus more on inflation for what seems to be quite a change from what we've seen over COVID and really the prior cycle.
And Sarah, this seems to be a somewhat hawkish report, but nevertheless, I'm looking at stocks, and the initial reaction is to the upside. Also seeing that given the fact that the members of the Fed are expecting 3 rate hikes next year, that is the median number. The Fed OIS swaps, I'm just reading this headline right now, is now reflecting that. So what are the odds that the market is just comfortable with everything that's coming down the pike here, including potentially 3 rate hikes next year?
Well, this is a big shift from the September summary of economic projections, but it's not necessarily a big shift from what the market was already pricing in ahead of today's meeting, based on some of the more recent commentary that we've had from officials and the recent data. So markets were already, roughly pricing in 2.5 hikes. So the fact that the dot plot shows 3 for 2022 isn't that much of a change. When we look at where the median rate is for 2024, it's not much higher than where it was prior to this. So I think what we're seeing here is that these changes were well telegraphed. And so I think that's at least helping for now. Things seemingly stay pretty smooth.
Sarah, when they say that inflation is basically the result of the supply-demand imbalances, are they missing something with the tremendous amount that they're holding on the balance sheet? And when Jay Powell's asked about this, what would you want to hear his response be?
So I think in terms of those supply-demand imbalances, it comes from everything from the amount that households are spending on goods, but also even what's considered services like housing. So the fact that we have seen preferences shift in light of the pandemic. Now, part of that strength in housing costs, that is one of the big factors fueling the more recent momentum in inflation, is from the fact that we have seen such low rates that's allowing these higher prices. And so I think that does play into it to some extent.
For some help on that, we're joined now by Ed Al-Husseini, Columbia Threadneedle Investment Senior Interest Rate and Currency Analyst. Ed, it's great to see you. So as we kind of figure out what to make of the Fed here, something that we have been consistently surprised about is the sort of lack of movement in rates. Yes, we've seen more movement on the short end of the curve, but even so, given that we're going to see tightening at this point, what do you think is the cause of that?
Yeah, so a couple of things. One, on the front end, we've done a relatively good job of pricing in this pivot from the Fed really over the course of the past 3 months or so. So the Fed's recognized that inflation surprised to the upside relative to their forecasts and relative to the market forecasts. They have internalized that by accelerating the taper, and they signaled that almost as soon as they announced the taper in November. And we've been moving to a space where the thresholds for both the taper and hiking rates next year is coming into view. And so I think that's been consistent with the front end repricing. The longer end, of course, is hostage to a lot of secular factors that really haven't gone away and, if anything, have intensified in the course of the pandemic. And so the curve is flattened.
Ed, what's the give us some trades here. What's the hot trade post Fed this morning?
The hot trade. Well, look, I'll say in the interest rate space, the front end of the curve. Think about the 3-year point, the 5-year point on the curve, offer a very attractive carry. And when you're looking at a curve that's relatively flat, what you're looking for is risk reward across different maturities. And at this stage, I would say the 3 to 5 year segment is very interesting. The risk to a position like that, being long, being exposed to that portion of the curve, is that the Fed has to tighten very aggressively and tighten financial conditions in the course of the next year, right? So something they've been hesitant to do, something they signaled yesterday, was premature. That would be the risk, but for now, that carry is available in the front end.
And what about, we were talking earlier in the show too about the differential, the spectrum that we are now seeing between the big central banks, right? With the Bank of England today saying it's going to be raising rates, the Fed's sort of in the middle, and then the ECB saying probably not happening in 2022 for us. So as a strategist and analyst, how do you sort of take advantage of that differential?
Yeah, absolutely. So we've had a really nice run in the dollar because the Fed pivot got priced in, so U.S. front-end rates rose. But I think equally importantly, the U.S. economy has managed to surprise to the upside in the course of the last several quarters relative to Europe. Europe and the U.K. Saw a bigger downside from the Delta wave and are seeing a bigger downside now from the early stages of this new variant. So that growth differential got baked into a stronger dollar. I think that trade is to some extent coming to an end. So particularly versus pound sterling, you see the pound sterling moving sharply higher today. That trade probably has some legs. But more broadly, taking a step back, dollar strength probably isn't on the cards to the extent that we saw, over the past 3 to 6 months. We'll probably see a flatter to a weaker dollar in the first half of next year.
And I've had several strategists tell me to expect a rate shock next year. Do you expect something like that? And what would that even look like to you?
Yeah, well, I would kind of highlight two tail risks, right, from here. We're priced for a relatively shallow cycle that ends at about 1.5% in terms of Fed funds by the end of 23, and then flat lines from there. Think about the two tail scenarios. One is the Fed has to tighten much faster and to a much higher terminal rate, so let's say to 2.5% over the course of the next 12 to 18 months. That's one form of rate shock. The other rate shock is growth slows, inflation slows organically, and the Fed doesn't actually execute what's in the price. So rates actually have to come down. And so I think a lot of how you position in risk assets next year will be a function of what probability do you put on these two tail events. And I think right now, the data isn't really consistent with the Fed having to tighten that aggressively. So I would put more probability on the fact that they underperform what's in the price or meet it at this stage.
So, and is that overall your biggest risk, do you think, going into 2022?
The biggest risk in 22 is this continuing inflation story accelerating, right? The Fed expects some moderation in inflation in the first half of the year, and then inflation coming back down to target by 2023. We don't want to use the word transitory, but in fact, that's what it is. And it envisions that happening without them having to tighten policy very aggressively. 2 to 3 hikes next year doesn't qualify as an aggressive tightening cycle. The risk is that they do have to move into that mode and shift gear into a much faster tightening cycle. That will be an environment in which rates are rising, particularly in the front end of the curve, and risk assets are selling off because the Fed is tightening financial conditions. So you have wider credit spreads and weakness in equity markets. That's a situation we last saw in sort of early 2018, if you think back, when there was sort of a parallel sell-off in risk and safe haven assets, and that generally tends to be quite painful for portfolios. So that would be my key risk for next year.
We'd like to bring in a panel of guests, Dana Peterson, the Conference Board Chief Economist, and Jeanette Garrity, Robertson Stephens Wealth Management Chief Economist. Thank you, ladies, both for being here today. I want to start with you, Dana, and just get your perspective on what you think of the decision that came down. It was fairly hawkish, but markets sort of liking what they see. So how much of this has already been baked in, do you think?
I think a lot of this has already been baked in. Certainly when you look at OIS, Fed fund futures, markets were already anticipating 3 rate hikes for next year. And the Fed really delivered in terms of the dot plot moving higher. And certainly, I think what's maybe keeping markets a little bit calm is that the Fed isn't looking for 10 or 12 rate hikes over the course of the next few years. It's still 8. And still, even if we have 3 hikes next year, we're going to have interest rates that are well below the averages that we saw decades ago. And even with 8 hikes, we'd still only be about 2%. So I think with all that, markets are probably taking into account the fact that inflation has been very high. Meanwhile, the labor market has been healing, and the Fed really does need to act. And this ripping the Band-Aid off, so to speak, was very important to do today.
Hey, Dana, it's good to see you. It's good to see you too, Jeanette. Let me throw this question to Jeanette. As investors, as consumers, what's going to change in our lives over the next 6 months? Is it going to be mortgage rates? Is it going to be, credit card rates? Where are we going to feel whatever's about to happen?
Well, it's interesting you cite rates, right? Because that's going to, I think that's going to hang on when the Fed decides to start actually raising short-term rates. And then one would expect over time that all those rates would move up together. But I don't think much is really going to change in 6 months, which is why Fed policy mavens always know it takes 9 to 12 months for any policy action to feed its way into the economy. So not much in 6 months. I think this is very much a story about the second half of 2022, actually. And I agree with the comments beforehand that the good news about this press release is that this is what everybody was thinking. and was sort of baked in, but you notice that the market is now coming off where it was in kind of a relief. I got to wonder if the first reaction being way up was, yeah, we knew this, but now it's done. Good, we can go do the holiday parties. And now half an hour later, people are thinking about exactly what 3 rate hikes mean. It is a very hawkish press release. Absolutely think it needed to be done. Absolutely, but it's hawkish.
And Dana, we were talking with Michael Gapin of Barclays just a few minutes ago, and he said his belief was that the market is reacting positive to this. We have stocks up right now off of the announcement because maybe the terminal rate, the total number of rate hikes, looks like it's only going to be 8. That's what the FOMC members are expecting now. I'm just wondering, do you agree with this, or how are you viewing the summary of economic projections data that we got today?
Sure. I think certainly, again, markets are looking at the number of hikes and seeing that it's not different relative to the prior SEP, even though they're accelerated. And I think, the big concern is if we continue to have elevated inflation, what's it going to do to economic growth? Now, we noticed that the Fed did raise its expectations for growth next year and then lowered them a little bit for 2023. So they're anticipating that their actions are going to dampen growth, certainly in 2023. But still in all, that's pretty much the average where we were before the pandemic. We were growing around 2.25%. So the Fed's actions still suggest that we're going to have very robust growth. The labor market's probably going to continue to tighten. We're probably going to continue to have labor shortages that are going to feed into wages and consequently consumer inflation. So it makes sense that the Fed is doing this. And I think markets are starting to absorb the benefits of the Fed deploying less accommodation in terms of monetary policy.
And Jeanette, I want to ask you, the wild card in all of this could be, if we get any insight into the balance sheet. It's currently at 8.7 trillion. It was 4 trillion before the pandemic. When does that likely get reduced? Do you think we hear anything from that? Because obviously he's going to be asked that question.
I think he's going to be asked that question, but I would be surprised if he really talks much about it. I think the big storyline, and he's going to stick to it, is the taper and the interest rate movement. Remember, in previous press conferences, he hasn't even touched the issue of interest rates. He's avoided it like a plague. So now he's going to talk about it. That's going to suck all the air out of the room. And by the way, I want to call attention to in the summary of economic projections, the most interesting number to me is the long-term outlook for 2024 and beyond. The signal is 1.8 to 2% GDP growth. That tells me that the Fed is thinking in terms of a very different labor force, population growth and labor force growth than they were anticipating 2 years ago or 3.
This one's for Dana, because so much of what your employers do is based on consumer sentiment. How are the average men and women hearing what we're talking about going to feel going forward? It's not really going to impact any of that, is it?
Well, it depends on who you are. If you're looking to buy a home, you're probably shaking your boots right now because you know that mortgage rates are going to rise, and the mortgage rates are going to rise much more quickly than inflation is going to fall off. And certainly, I think that, the average person will probably feel internally that it's great that someone's listening to us, that they understand our plight, that we are seeing an erosion of our purchasing power, the rising prices for everything from food to shelter to energy and even, discretionary items. It's really harming us. And so I think the signaling will be positive. However, they probably won't feel it for some time.
And we will stay on the markets and bring in our next guest, Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Kathy, thanks so much for being here. I want to get your take, first of all. Did the Fed move too fast, too slow, or was it just right? What's your take in its change of mood? And, what is the bond market today telling us? What is it messaging after the decision?
Well, yeah, I think the Fed was moving fairly aggressively relative to expectations. Now, some of the rate hikes had been built in, but I don't think the market was expecting to see The dot plot indicates 3 rate hikes in 2022 and another 3 and another 2 over the next couple of years. So it seemed like the expectations for rate hikes were a bit above where or below where the Fed actually came in. But at the end of the day, the market has been pretty sanguine about the whole thing. We've actually seen bond yields fall a bit. And I guess that tells us a couple of things. I think one is that the market's not sure that the Fed will actually be able to raise rates as much as they say over the next couple of years. When we look at where the forward rates are implying, it doesn't get up to the 2.5% Fed funds rate that the Fed is projecting. It's more like 1 3/4. So the market may not believe the Fed is actually able to accomplish what it says it's going to accomplish. And then I think there's also a component in the market where there's worries about the Omicron variant and some of the other headwinds to growth, particularly in the global economy. And it seems as if the market is saying, well, you can try to be that tight in policy, but you might not get there.
Kathy, always great to see you here. Just thinking about the yield curve here, we have the 5-year note, I believe that's down about 9 basis points. The 10-year is down about half that, and the 30-year is up 1. So we have a steepening of the yield curve, a bull steepener here. What is that signaling to you about the market's interpretation of what the Fed is doing and perhaps the terminal rate at which the market thinks the Fed will eventually stop raising rates?
Yeah, so the initial reaction was a little bit surprising because the yield curve actually flattened a bit, and today we're back to steepening a bit. So it's really bobbling around here. I think the steepening would make sense in this environment. I think the yield curve has been awfully flat for this part of the cycle and should probably steepen somewhat, particularly since we're still seeing those inflation prints come in pretty high. And that should lift up the long end of the curve. It also should steepen a little bit because the Fed is going to is going to taper more quickly. So their influence on long-term rates should decline. But that being said, that terminal rate at 2.5% looks very high to the market because we can't seem to get the 10 and 20 and 30-year yields anywhere close to there. And we're not seeing that in any of the forward rate indicators. So I think there's still a certain amount of skepticism in the market that the Fed can move as quickly or as high in terms of rates as the dot plot is indicating.
And Kathy, what does the inflation outlook look like for you? Do you think that it starts to ebb? Have we seen it peak? What's the picture like over the next 6 months?
Yeah, we think it certainly should ebb over the next 6 months, partly just the technicals because, this is a year-over-year rate of change that we look at. And given that last year's numbers now will show a very high rate of change, even if the rate of change is positive, if it's a slower rate of change, it's going to bring the inflation number down. I know that's a lot of wonky stuff, but they call the base effect. So to some extent, we're likely to see the inflation prints come down just because of those technical conditions. We also think that some of the supply constraints seem to be ebbing a bit. We're starting to see inventories pick up relative to new orders. That's a good indication that some of the bottlenecks may be cleared. The big question going forward, I think, is what happens with some of these new shutdowns in places where the virus has surged again. Is that going to create more bottlenecks, or are we going to see those prices ramp up? So I think 6 months, probably somewhat lower. When we go forward, it really depends on the supply side of the equation.
And Kathy, first of all, I want to give you license to be as wonky as you want. I love bonds and I love getting wonky on bonds. But I want to talk about not tapering, but I want to talk about an actual wind down, quantitative tightening of the Fed's bond portfolio. And Powell was asked this yesterday. He said we haven't thought about it yet, probably on the agenda for next year. But with $8.7 trillion on the Fed's balance sheet, is that concern for the markets? Should they be thinking about should they be thinking about winding that down?
Yeah, I think that if the Fed wants to achieve its goals, it will need to look at unwinding that balance sheet a little sooner than they did the last go round. So before, it took a couple of years before the Fed moved from, stopping the taper to actually letting bonds roll off the balance sheet. But I think that high balance sheet, along with the big balance sheets we see in the Bank of England and the ECB and the Bank of Japan, are really kind of holding down yields at the long end of the curve. And that can have a deleterious effect because you can't get the yield curve to steepen very much. And if it starts to invert with the Fed tightening, that could be a real tightening in financial conditions. So what that means is that you go from having a very easy policy to a very tight policy. And one of the ways to mitigate that is actually to allow that balance sheet to decline, let the market price in rates at the longer end of the curve, and that should restore, I think, a more normal kind of monetary policy. Now, that's going to take a number of years. It's not going to happen overnight. But I think if I were at the Fed, I would be thinking about doing that sooner rather than later.
And Kathy, I want to ask you, do you think that the Fed and Powell have sort of abandoned this dual mandate looking at labor as well? Because yesterday he said the labor market is solid. Today we saw initial unemployment claims go up slightly to 206,000. What does the labor market look like at Q1 and Q2? And particularly, labor participation, which has been a big issue.
Yeah, I was surprised that Powell didn't just come out and say, look, it looks like we're at full employment or close enough to full employment to start thinking about tightening, because that's essentially what his message was, that it's solid, that we're moving in the right direction, and we've opened the door to tightening policy because those wages have started to rise. And he did indicate that those unit labor costs were was the motivating factor for his shift towards tighter policy. So I think he probably should have just come out and said, yeah, we're pretty close to full employment. It's time for us to tighten policy. I think the question about labor force participation is really one that's going to drag out for a long period of time. We are optimistic that participation rate will come up a bit, but it's going to take a lot longer from here than it has over the past year. And to sit back and let inflation build up, waiting for that to happen, would probably be a policy mistake.
For more reaction on the Fed and what this all means for markets, we're welcoming in Peter Hayes, BlackRock Head of Municipal Bonds. Peter, thank you so much for joining us. I first want to get your reaction to the Fed's statement and press conference yesterday. Now, there was a lot of discussion around inflation and where we are in the path toward maximum employment. Let's take a listen to what Fed Chair Powell had to say.
Essentially, higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is catching up, seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle.
Peter, when you look at how Fed Chair Powell described this path toward maximum employment, the speedy rate of recovery, the dot plot, and the press conference overall, was there anything that really surprised you in these or that you think may have surprised the markets?
Well, first of all, thanks for having me back. I appreciate it. One word actually stood out, and particularly the way Chair Powell emphasized it, and that was much, said much faster. So I think the Fed has been a little bit surprised here, both I think the pace of inflation and the pickup of the employment rate as well. They used this word transitory for a long time. They've taken that out of the statement. So I think they realize that the price pressures are here to stay. And the markets have been sort of skeptical of whether the Fed was behind the curve now. The Fed, I think, has done a good job of being very deliberate. All along, they've said it depends on the pace of economic recovery here in the U.S. It depends on the pace of the recovery in terms of unemployment, et cetera. So I think now they have plenty of data showing the sustainability of this. And with the markets perhaps guessing that they're a little bit behind, they're actually in a bit of a catch-up mode, coming out and saying that perhaps 3 tightenings in 2022, which when you go back 6 or 9 months ago, that's quite a bit more aggressive than where they were. The interesting part is the market reaction. The market, 20 years ago in a bond market I grew up in, we saw this type of inflation data. We saw this type of statement out of the Fed. Interest rates in the bond market would have sold off much more dramatically. It started to sell off and then it come back. Today, a bit of an interesting reaction in that the curve is actually flattening. So the front end is taking out to some degree some of the tightening that perhaps it had built in. Maybe that's around this new variant and the slowdown that's in front of us.
Right. Hey, Peter, good to see you. So for people who want to invest in munis, what should we pay most attention to going forward? Is it the increased pace of tapering or the potential for liftoff with treasuries and interest rates? I mean, it could be as soon as March. What's going to impact the muni market most?
So first and foremost, it will be the pace of tapering, the pace of tightening, and the reaction of interest rates. It's a fixed income market. If interest rates rise, it will impact municipal prices. They will go down. Now, a bit of good news, municipals tend to do better in rising rate environments than other fixed income asset classes. In fact, there's some other dynamics at play this year that we've talked about on past shows. But nonetheless, when you look at municipal aggregate index returns this year, up about 1.5%, while other fixed income assets are actually negative for the year. So there's a bit of protection built into the muni market. But nonetheless, if we see dramatically higher rates from a Fed tightening and a market that begins to expect more tightening beyond the 3 they're talking about in 2022, prices will be impacted negatively, definitely.
Well, and Peter, thinking about fixed income more broadly, what is the case for investors to be allocating a portion of their portfolios to bonds right now? Because many of the strategists that we have on here have been talking about that they still favor stocks over bonds as we head into 2022, even with these potential interest rate hikes. So what do you have to say about the potential benefit for investors in this asset class?
It's a hard case, and that's why I'm smiling at a bond person and sit here and say, we should be in bonds. Look, the bonds, particularly cash, the front end, is not keeping up and not giving enough income to keep up with the pace of inflation. Whether you believe this rate of inflation is 5% or 4% or 3%, those numbers are all above where you can find yields in most fixed income areas, particularly out through 5 to 7 years. So I think if you want a little bit of income, you probably need to go out the curve. And muni market, for example, there's probably some good value in the 15-year part of the curve. You'll pick up some income. You don't have the exposure to the front end if the Fed begins to tighten. But to your point, Emily, it's tough to make a really strong case to allocate a lot of money into bonds at this point in time. I think the market, that earlier discussion we had about the Fed and what the market is expecting, I think the market still has to come to the realization that the Fed's going to tighten. They're going to reduce their balance sheet. Someone's got to buy those securities. They're likely to want to get paid a premium to buy those securities, which means higher rates. So I think you have to be patient in the bond market and tough to make a case to reallocate in at these levels.
Hey, Peter, when you advise your clients that, you're overweight higher quality states, essential service bonds, and then you talk about school districts supported by property taxes, I get that. Someone who's risk averse, that rings true. But then at the bottom of that, you're talking about select issuers in the high yield space. In a different part of the note, you talk about how well Puerto Rico did, and they are clearly in the high yield space. It was about maybe 5-6 years ago. We were talking about potential for default with Puerto Rico. They've lost population. What warnings might there be for people who want the better return in a high yield, whether it be Puerto Rico or perhaps some other municipalities? They're not out of the woods, or are they?
They're not quite out of the woods. The other day, Judge Swain, the bankruptcy judge, came out in terms of them emerging from bankruptcy and postponed it a bit. But I think the ultimate end game here will be in the next few months. They will emerge. I think a lot of the price appreciation in the debt, though, has been realized. Those who bought very early on and paid 30, 40, 50 cents on the dollar actually have made out quite well. So that trade, I think, is a little bit long in the tooth. But you ask a really good question about high yield. High yield, a lot of flows have gone into high yield. You can get a fair amount of income there, which is tax-free. But high yield can be very different. High yield can be sectors like charter schools and tobacco and even Puerto Rico, which probably have a much better, I think, a much better and more optimistic outcome, as opposed to the smaller project finance, which are highly more speculative. So you have to know what you're buying in high yield. And I think you have to be prudent about how you buy high yield as well. It's a really important point.
Let's bring in somebody who's quite familiar with how executives are looking at this issue. Rich Lesser, Boston Consulting Group CEO. Rich, it's always good to talk to you because you give us a good pulse of what's happening. The conversation is happening in the C-suite. Having said that, you're quite optimistic about 2022. And I wonder, when you look at the headlines we've gotten over the last week, especially, whether that changes that outlook for you.
I think the next couple months, Omicron's going to go very fast around the world and through our own country. I think it's incredibly transmissive. The good news is so far, the danger of it seems to be lower, certainly than Delta, maybe than the original strain. And that's that. If it tests out, well, it'll take weeks to know for sure. That will be an encouraging thing. But still, when you infect so many people, even at lower danger rates, it could still overwhelm health systems and create enormous near-term challenges. So the short-term pressures could be substantial. I do remain, from an economic point of view, optimistic about the year ahead. I think we're on track for a good year, and I think some of the headlines that talk about inflation risk or talk about other risks mask the underlying strong demand, the strong growth in the workforce, and a drop in unemployment levels, inching back of participation levels that needs to continue to rise, and working through some of the supply chain issues that we've all been dealing with. I think net Q1 may be tough because of Omicron, but the quarters after that I think should be quite good.
I think you and I are pretty similar there, Rich, in that I am also an optimist when we're looking at everything that's going on right now. We're trying to figure out what I guess the medical impact might be here. But when it comes to some of those issues, obviously the longer you push out, I guess, a full recovery, those will persist. So explain the optimism to me there in terms of, I guess, how businesses can navigate all this if their return to normalcy seems like it's getting pushed out even farther and farther.
I think we have to separate two things. Yes, things get pushed out, but I think the Bloomberg average sentiment going into this year was we were going to have 3.9% GDP growth, and now it looks like we'll have 5.5%. Had it not been for some of the challenges we've discussed many times, it would probably be north of 6%. So it has had an impact, but against the backdrop of a strong economic year. Next year, I think our projections put us in the 3.5% to 4% range of growth, well above the 2% long-term trend line growth of the U.S. So I think, and business leaders, I think we'll see strong demand, healthy consumer balance sheets, and that's good. The challenge of getting our workforce back, the main challenges now all sit on the labor side. The stresses that our employees feel, the mental stress, the challenge of managing through their families, the challenge of getting enough workers. Most of them feel short on the labor side. They're investing heavily in capital and automation to try to address that in the medium term, but the short-term challenges are real, and everything on the stress side, I think, will sit more and more on labor and getting more workers and getting the right workers for a more digital world, and new capabilities. But I think businesses will work through that against the backdrop of generally good performance.
Yeah, let's touch on that a bit more, Rich, because if you think about the challenges we're seeing right now in the economy, it's not so much about the trajectory as in the demand has bounced back. Consumers have shown they're willing to spend, but there's just not enough workers, and the supply demand dynamics are just not in sync. When you talk to executives right now, what are they seeing on that front? I mean, you mentioned automation, but ultimately that's kind of, medium term, long term. Exactly. At least in the first half of the year, do they see some of those labor constraints easing up?
Easing, but not as fast as they would like. I mean, we've got 3 different pressures running around that are affecting the workforce. Well, 4. One is a general skills level. The jobs that are available aren't necessarily the skills we need. And I think so much of our work has to be retraining our workers for the jobs of tomorrow to help them be prepared. But in the very near term, we've shut off the immigration tap. We have middle-aged workers with young families facing enormous pressure, partly due to childcare type issues and other things that suppress it. And we have older workers who've often moved towards either a temporary or a permanent early retirement. And we need all 3 of those levers to be eased to get back to what we'd like. The good news is the unemployment rates themselves, I mean, we're as close to full employment. It took 90 months after the great financial crisis to get back to full employment. We've gotten there in 18 months. So that's encouraging, but we need to get participation up. And I do think many companies are feeling pressures just to get more people right now.
You mentioned kind of 2 things there. I wonder how big of a hangover impact there might be on growth when it comes to, I guess, why labor force participation has dropped a bit. And some people might lean on the fact that you had a lot of older people in the workforce just calling it early and saying, look, I might as well retire right now. And I wonder what kind of lingering impact that might have. And plus, also, when we talk about why things were good for businesses last year. It seemed like there was a lot of ability to pass along price increases to the end consumer. I'm not sure if that would be able to hold up next year, depending on what happens. But when you factor both of those things in, what do you see changing in 22?
So first, you're right. A number of older workers who might have normally stayed in the workforce for longer have withdrawn. Whether that's permanent or temporary, we need to see. The balance sheet data of that population suggests, they don't have enough to be permanently retired. I mean, individuals, of course, but many of them. So I think, though it's coming back much slower than we would like, we may well see a rebound in participation over time, particularly as we get beyond COVID and some of the fears that's induced, that I think cause at least some people to say maybe it's time to step back from the workforce, and they can afford to do it in the short term. I think the second thing that the businesses are wrestling with is, yes, you're right, price pressures have been severe, and our cost pressures due to inflation, and they passed some of that along. I think we're seeing energy prices moderate. For sure, we won't see prices going back down, but I think there's every reason to believe we're not going to see the continued inflation that we've seen. Remember what we're comping against. When we look at one-year inflation rates, think about where the U.S. and the world, frankly, was, because inflation is not just in the U.S., where the world was a year ago at this time. By the time we get into Q2 this year and Q3, we're going to be comping against a different environment. If we can avoid getting in a wage price spiral, which is what I think a lot of the Fed actions were geared to address this week, if we avoid that, then I think we will see inflation moderate and get back to much more normal levels. And that's certainly what long-term bonds are saying. That's what long-term household surveys are saying about their 5-year inflation expectations.
And finally, Rich, we got that news from Google this week saying that they would fire employees who don't meet the vaccine mandate, given that, the company has said they're going to give their employees about 6 months or so to be compliant. It feels like there's growing impatience around this issue, and companies are starting to say we have to draw a line in the sand if we want to get back to as normal as possible. Do you see that divide growing between companies who are saying, that's it, you've got to get mandated, you've got to get vaccinated, or else you'll be fired, and those who say, we're just not going to do any mandates?
First of all, I think most companies believe deeply that they need their employees to get vaccinated and are frustrated at how hard it's been, the way the issues become politicized, and just how difficult. And I think more and more are trying to find ways to provide anywhere from encouragement to pressure to mandates to accelerate that. I mean, we went down that journey. We spent a huge amount of effort on education and getting our own colleagues to understand the need. The vast majority of them did get vaccinated, and then we moved towards a mandate in September, but it was really just for the last couple percent. I do think we'll see some movement in that direction, particularly when labor is so short. I do think a number of companies that would like to move in that direction feel tremendous pressure at the risk if they have too many people leave the firm as a result, that it'll put them in a very difficult place. And depending on where your facilities are located, the composition of your workforce, that pressure can be quite real, where so many Americans have chosen not to be vaccinated so far, despite all of the evidence and all of the education.
But we want to stay on the markets for right now and bring in our next guest, Dan Ai from Fort Pitt Capital Group, the CIO there. Thank you so much, Dan, for being with us on this very volatile Friday. Just want to get your sense of what's going on in the markets right now. Are we seeing anything of a tapered tantrum? Tech stocks were up on the initial Fed decision, then down, then up, then way down, now less down. And how much of this is also this triple witching phenomenon that happens once every quarter as well, playing on markets today?
Yeah, well, thanks so much for having me. It's nice to be with you. It does look like volatility's back in the near term, at least. And I think, the trading activity that we've seen over the last few days is really, indicative of markets adjusting to the new reality of waning liquidity and the prospects for tighter policy from the Fed going forward. It looks like we are seeing a little bit of relative strength or outperformance from tech and the small caps, which were beat up pretty good yesterday. Maybe that's a small positive sign for us.
Dan, this is Emily here. Going back to your point on tech outperformance today, we're also seeing some moves in the Treasury market, seeing some flattening of the Treasury yield curve. I'm wondering, what do you think the Treasury market is telling us right now as we have that 10-year yield now below 1.4%?
Yeah, I think, looking at long-term or longer-term yields or interest rates, it really is a head scratcher. I think it is, it's indicative of the market expecting that, the Fed raising interest rates will, slow growth eventually. But, it is really hard to square, a 10-year Treasury yield below 1.4% when we just saw, a headline inflation report at 6.8. I mean, that's a negative 5.5% real yield on a 10-year Treasury. The kind of negative yield I would associate with deflationary, depressionary times or wartime type of periods, not at a period where we're seeing strong equity markets, surging housing prices and corporate profits.
Dan, what do you make of the Fed's decision, telegraphing 8 hikes into 2024? Is that something they can actually pull off, or is it too fast to taper, do you think?
I think that's a great question. I would take the under on that assumption. We just talked about where long-term yields are. If we were to see 8 or 9 interest rate hikes, that puts the Fed funds rate at 2.25. Unless we were to see an aggressive move up in long-term rates, that would, invert the yield curve, which has historically been, a pretty good warning sign that the Fed has gone too far, too fast. So I think if we look back over the last, decade, we've seen that the Fed has pretty aggressively overestimated their ability to hike interest rates. So again, I would take the under on that bet.
Dan, taking a look at the notes that you sent over earlier to us, a couple of the stocks that you highlighted, Apollo Global Management, that is the parent company of Yahoo Finance, as well as Broadcom and Lowe's. What is it about these stocks that you like, and what do you think investors should be focused on with these areas?
Yeah, so first on Apollo, we've seen just incredibly strong inflows into the private equity complex in general. We think that trend continues in a low interest rate environment, and that Apollo will be a significant beneficiary there, given their focus on credit and yield replacement strategies for their investors. Management has set a pretty ambitious goal of doubling assets under management over the next 5 years, but that's right in line with what they've done over the previous 5 years. The stock's done well recently, but it still trades at a very undemanding valuation of about 13.5 times next year's earnings estimates, which is a big, valuation discount to the market and also to, private equity peer groups. On Broadcom, we really like the diversified exposure of their end markets. So, data centers, wireless, cloud, and industrials. Really strong earnings report last week. I think it shows that the business is just firing on all cylinders with strength across all their segments. We saw a double-digit dividend hike, which we've come to expect from Broadcom, given that they generate almost 50%, free cash flow margins. So, looking at their pipeline, the rebound in enterprise spending, and continued strength in cloud, we're expecting another really strong year from Broadcom next year. And then finally on Lowe's, first thing I would say is that we do expect, tough comps for Lowe's, given very strong years in 2020 and 21. But we are impressed with the progress that they're making on their turnaround initiatives. They're becoming a better retailer. They're operating more efficiently. They've really utilized their labor force more efficiently and build out their online infrastructure. So we think that they're closing the operational performance gap with Home Depot, and we think there's more to go there. But with the stock trading at about a 20% valuation discount to Home Depot, we continue to see an opportunity.
And Dan, I want to turn your attention to central banks. A myriad of them have been weighing in now recently, and they seem to be signaling that Omicron isn't that big of a threat. They're more focused on inflation. Do you think that it is a mistake to discount the potential, at least near-term disruption that this new COVID whether it's Omicron, whether it's Delta, we don't even know, but this surge in cases that we're seeing in the U.S., because it is disrupting businesses, return to work, restaurants are closing, Broadway's affected.
Yeah, obviously the new variant is here and it's spreading quickly. Now, that's not necessarily new information. I think we firmly expected to see that given the data that we've seen out of South Africa. But I think we continue to hear pretty positive news, from South Africa that there's much lower severity compared to Delta. We saw some headlines and data points out just this morning that hospitalizations are more than 90% lower compared to the similar period of their Delta wave. So, and in the U.S., I think there's very little appetite from the American people for severe restrictions or lockdowns that we dealt with in the spring of last year. So I think the real risk centers around more supply chain disruptions or pressures in areas like China and other parts of Asia that have adopted much different COVID, policies than the U.S.
Well, and Dan, tying in this threat of the Omicron variant with monetary policy and with what Fed Chair Jerome Powell said about the moves towards maximum employment earlier this week, he mentioned we are making rapid progress towards maximum employment. Do you see the Omicron variant potentially throwing a wrench in this move and this recovery?
No, I don't. I think we've dealt with a number of waves already. I think we've established a pretty reliable pattern, if you will, that when we do see case counts rise, it has affected consumer confidence and maybe some consumer spending. But as we hit the peak and those cases fall, we see those things storm right back. So I think I think we're learning to deal with COVID, and we know it's going to be a part of the backdrop going forward, whether it's this variant or the next.
I want to bring in Steve Sosnick. He's the Interactive Brokers chief strategist, friend of the show. And Steve, I'm surprised to see the market reacting more to the Federal Reserve's pivot this week than what we're seeing on the COVID front. I mean, this is a big ongoing problem. Do you think the market has to correct to adjust for it?
Good morning, Brian. To some extent, yes, and I think we're starting to see that in the reaction. Let's say, the sort of the schizophrenic reaction, down, up, then back down that we're getting. I think that there's also this feeling in the U.S., though, that we're not going to do too much about it. Those who are vaccinated are living one set of lives, and those who aren't are in another. And different states are going to do different things. I think the market is saying that they don't see a big will for lockdown in the U.S. And I think that's the reality that we're going to face in the short term. And I think the market is just sort of saying, look, this is not a good thing. We know it. But from an economic point of view, if there's no change in that much, if there's not a huge behavioral change, then it's a human problem, but it's not necessarily a market problem, at least for now.
Well, and that's interesting, Steve, that you say that, because, you could sort of see that in the trade that we were watching yesterday. Now, on the one hand, we're hearing a lot of companies now that are delaying return to office plans, right? You've got Apple and Alphabet saying indefinitely, right? They don't know when they're bringing employees back. Jefferies is now telling employees to work from home, at least for now. And then you see the other list here. Of course, there was also that JP Morgan big healthcare conference. It's going to be virtual in January. So if people were paying a lot of attention to this and putting a lot of stock in this, one would think that you would see a big return to tech stocks, for example, and other stocks that were working during the pandemic. And yet that wasn't necessarily what we were seeing yesterday. But it also felt odd on the rates front. It didn't, in other words, it's not like we were seeing a spike in rates that was causing the sell-off in tech stocks. So it's just, what can we even make of the action over the past couple of days?
It is disjointed. This is what happens when you have, markets that are, up sharply into year end, throw in a Fed meeting that's not necessarily market friendly. It wasn't as unfriendly as it could have been, and throw in a quarterly expiration today. And so you're going to get some wacky moves. That is more or less the recipe for volatility, and I think that's what we're seeing. On the bond front, I find it interesting. I think the bond market is still, the 2 years don't seem to be reflecting the full dot plot. But I think that's just as much a function of the idea that there's still, yesterday was a record in terms of reverse repos, which means that there was $1.6 plus trillion that had nothing better to do than go to the Fed and seek 5 basis points. So there's still a lot of, I'm going to call it fixed income cash that's sloshing around out there. And that's definitely having still a distorting effect. I think you're not going to see the full effect of what the Fed's trying to do until we sort of work through that pig in a python, so to speak, of all that excess cash. Remember, they're still adding it to the economy.
Steve, you write in your morning note today, quote, the rises in the major indices were obscuring broader market malaise behind the scenes. What type of malaise are you talking about here?
For example, the highs on Friday were not at all confirmed by the advanced decline line, which is sort of a basic one. We're seeing narrowing leadership. New highs, new lows have not been at all commensurate with the type of things that you would see at or near a new market high. You're actually seeing lows outpacing highs, and this is telling you that the leadership has been getting more narrow, and you can do that when you have essentially 7 companies that make up a quarter of the S&P 500 and 50% of the NDX. The problem is a day like yesterday, when the market decides they want to take profits in those 7 companies, and it drags everything lower. The problem when you have narrowing leadership is if that leadership turns, it can be very crowded if people want to seek the exits, and I think that's kind of what we saw yesterday. It's hard to disassemble what is year-end profit taking, what is just lightening up your books. But when we saw, for example, Apple rise 20% in a month without an obvious catalyst, the real news story that affected Apple was they warned their suppliers that they were going to be light on iPhones, but yet the stock rallied 20%. We're giving a lot of that back. And I think that's, sort of the market working through some of the excesses, and I think some position square. I think you had this rush to get into Apple before the end of the year, and now this sort of moment of, ooh, wait a minute, if everybody's in it, where am I going to go? And I think that's the kind of mentality that you see reflected in the market to some degree.
And let's also focus in on your area of expertise traditionally, which is options, right? You mentioned expiration that is happening today. And we are also seeing, I don't know if it's record open interest in terms of options activity, but it's close to record, right? And so as we see these moves, how much are they magnified by what's happening in the options market? Is that kind of walk us through the effect that is having on everything else you're describing?
Sure. Well, one of my little weekly mantras is, every time a stock crosses an expiring option strikes, some trader has to rehedge, kind of borrowing from It's a Wonderful Life there a little bit. Mm-hmm. But this is the case, and somebody needs to rehedge, and we've seen this massive call speculation. That's been individual investors adopting equity options in an unprecedented manner, in a way that those of us who've been lifers in the option business never could have dreamed of. But what this does is it forces the street to rehedge around it. And everybody saw it's the market makers on the other side. With this much open interest, it's not just market makers on the other side. It's individuals, it's trading firms, it's everybody all over the place. But you see these effects, particularly on expiration. For example, this morning we saw the futures take a big leg lower, about an hour ago. And what had happened was, in my mind, I think because we crossed the 4650 level on the S&P futures, where there's a big expiring short open interest. What happens is whoever's short those puts then has to rehedge. Whoever's long the puts may want to rehedge as well. But you start to see these distorting effects, because once you go through strikes, if you're long, you want to buy low, sell high. If you're short, you kind of are forced to do the opposite if you want to stay hedged. And that's where you get markets sort of lurching in and out around expiration, because these effects get magnified. I'm not going to go into the math now, but the effects get highly magnified the closer you get to expiration. We're seeing it every week because weekly options are incredibly popular. But as you noted, today being a quarterly expiration with futures and index options as well as equity options expiring today, it tends to turbocharge moves. When the public is long the options and the pros are short the options, you tend to see those moves get turbocharged up or down. We're seeing a little bit of selling, and that's turbocharged at least this morning's activity.
Is this an underappreciated risk in the market right now?
Yep. Rather than giving you a one-word answer, let me give you a big one. Yes, because I think going forward, one of the things that I'm thinking about for 2022 is I think we need to expect more volatility. I think it's unrealistic to think that a liquidity-driven market that has really seen nothing but continual fiscal and monetary stimulus flowing in, I think it would be a little unrealistic to think that as that flows out, that you won't get hiccups. This week might actually be sort of the first of those hiccups, but I don't think you really start to see it until the taper is done or the taper really gets into motion behind us. But it's going to cause hiccups, air pockets. And I think as more people are involved in trading, you're going to see them. And one other thing to keep in mind, roughly a third of the people, give or take, haven't seen anything other than this extraordinary bull market. I think, around the street, it's about a third of new accounts have been opened since March of 2020. It's this completely unusual economic environment, but they've come to assimilate that as what they know for trading. And this is not a knock, but it's something you have to get educated about if you are a new investor, that the Fed isn't always a tailwind, that fiscal policy isn't always a tailwind, and that you can get market hiccups. And I think the market's going to have to get used to that going forward. And as people are involved in options, you can use them to speculate, you can use them to hedge, and come up with strategies that sort of have a little of each. But I think this is a time to be thinking about options more as a hedge or an income strategy than just outright speculation, which has been a very popular and profitable strategy for many.
We're going to keep it on the markets and bring in John Petrides, portfolio manager at Tocqueville Asset Management. Thank you so much for being here. It's a head-spinning day in the markets. Tell me what you make of it all of the volatility. How much is tied to this monetary change in policy by the Fed tightening? And then how much is just options, expiring? It's once in a quarter, triple witching scenario.
Well, I think it's been a head-spinning 48 hours. I mean, literally 48 hours ago to right now, the Fed announced that they were going to raise rates 3 times in 2022. And, on the cusp, by the textbook, you would think that bonds would sell off and growth stocks would sell off. That would be the reaction to when you're seeing a sharp increase expected for interest rates. And really what we saw was bonds kind of have rallied. And the initial reaction of the Fed was that growth stocks rallied. Yesterday, bonds continued to rally, long bonds rallied, and growth stocks sold off because the market woke up and said, wait, higher interest rates are bad for growth stocks. Now what's happening today? Well, more stocks are selling off, gold is rallying, and bond continues to rally, which means to me that today the market is taking fears of Omicron more seriously and that it could slow down the economy, where the Fed may just only have to do 3 rate hikes next year, and that inflation will be really contained because the economy will slow. So basically, you've gone from sort of a relief that the Fed is not behind the curve in raising rates to now fears that Omicron is real and it could help slow the economy more so than expected in 2022.
John, this is Emily here. We've been seeing this seesawing between cyclical leadership and tech and growth leadership for quite a while now. Over the past month, it really has been those tech stocks getting hit hard, though. So is this tug of war between cyclical and growth going to continue into next year? And if so, how should investors be positioned to potentially even capitalize on this volatility?
Yeah, I think you hit the right avenues to look at from a stock standpoint. All of that comes around interest rates and where the Fed may or may not go and where the economy's headed. So if the economy's increasing and growing faster and the Fed has to raise rates maybe more than expected, you'll see the cyclical stocks rally and the growth stocks where growth tech stocks, where valuation really has been stretched And in 2020, tech really benefited from a low interest rate environment. Now that's reversing. So it is a classic value versus growth trade when you look at those sectors of the cyclicals versus tech. And I think that is entirely a function of where interest rates are going to be headed. So, and I don't think, although the average growth stock, I think, is off prior to today, 13%, the average tech stock in the NASDAQ from its recent high, you may not have seen the bottom there if, the fears of an interest rate or increasing economy is going to improve.
And then let me ask you this. So do you agree with what the Fed is doing? Did they get it just right? Is it too slow? Is it too fast? And how good is their track record of actually pushing down inflation but not weakening the economy?
So I think the Fed recognized that they were behind the curve. Personally, I would have liked to have seen the Fed start tapering back in September, or at least announcing a tapering in September, and then they would not have had to have rushed it where they are now. But the fact that the Fed has increased their tapering and mentioned 3 rate hikes is where the dot plot is now for 2022. We were talking at maybe 1 hike in 22 and maybe nothing until 2023, and that was, those are the dot plots all the way back in June and July. So how fast and how far the expectations have changed in really a 6-month period is the impact that inflation has had in the economy. So, I'm happy that the Fed has kind of woken up to the reality of the situation, because the more they prolonged it, it would just mean the harder they would have to jam on the brakes. And when you jam on the brakes and you don't forecast the movement fast, investors get thrown off guard. And since liquidity has been so cheap for so long, money has been in risk assets for a while. If you deviate from the playbook and you add an uncertainty into the market, bad things can happen.
Well, and John, do you think the Fed is even potentially going to have to raise interest rates 3 times next year? Or do you think market expectations are going to kick in after this meeting and press conference? And is the market going to do the Fed's work for it?
I do think the Fed will have to increase their interest rates 3 times next year. I think that the main culprit will be COVID. If Omicron continues, if and when another variant then gets created globally, and that slows the global economy down, that could change plans, and that may prevent the Fed from doing something. You keep an eye on China. What's going on in the credit markets in China? The Chinese economy is slowing. That could reverberate to slow the global economy and could impact the U.S., could impact the oil markets. So, that could change the direction of the Fed. But right now, with where interest rates are, I think the Fed is doing the right thing here.
ARK Invest CEO Cathie Wood speaking with Laffer Associates founder Art Laffer about emerging investment decisions, capital markets, and cutting-edge technologies. Let's watch.
On inflation, we do have a controversial call here. I think the prevailing wisdom is we have an inflation problem. This is not transitory. And I will say that the supply chain bottlenecks have lasted a lot longer than I would have expected. And the latest version of that is consumers running out and buying holiday gifts well before they normally would because of supply chain issues that might prevent them from buying presents later. So we believe that the bigger risk here is deflation. And there are 3 reasons for this. 2 are secular, 1 is cyclical. The secular reasons, 1 is good and 1 is bad. So we are experiencing today the biggest uplift in innovation. We're in an innovation age, the likes of which we have not seen before. And the learning curves associated with the technologies that Barbara mentioned up front, the learning curves are characterized by cost declines. And I'll give you some of those. We focus our research on Wright's law, which is a relative of Moore's law, but it's a function of units and not time. And so for every cumulative doubling in the number of whole human genome sequence, costs are dropping 40%. And we're at a very low base, so we're going to see a lot of cumulative doublings. For industrial robots, that number is 50%. For battery technology or battery pack systems, that's 28%. When it comes to artificial intelligence, we are learning that training costs, so AI training costs, are dropping at a rate of 60% per year. So these are massive deflationary forces. And this is disruptive innovation at its best and most prolific, really, in the history of all time. The bad form of secular deflation is associated with the creative destruction associated with disruptive innovation. Now, we have seen since the tech and telecom bust, and then again, maybe even more so, the 0809 meltdown, increased risk aversion in the traditional asset management world. And part of that was a shrinking of investment time horizons, and the demands for profits and dividends now, which we believe, to the extent companies cater to that short-term point of view, that many companies have not invested enough in innovation and are going to be disrupted or disintermediated. They bought back shares to manage earnings. So a lot of financial engineering and leveraging up and to service that debt now, if their products are going obsolete, and we think a lot of products are going obsolete, they will have to cut prices to move these products. The third source of deflation, which this is the most controversial, cyclical, we're looking at the behavior of businesses versus consumers since really mid-2019. In 2019, the yield curve inverted and China-US trade tensions got worse. Businesses became risk averse and they stopped growing their inventories faster than sales. They cut back on capital spending. Then we move into the COVID crisis and they shut down. Then, of course, the government puts in place stimulus payments. The consumer saving rate hit 33% in April of last year. So consumers went to market. Really, it was to buy goods, which are only a third of total consumption. So they spent the year buying goods. They couldn't really buy services. And businesses have not been able to keep up with them. What we think is happening now is double and triple ordering, which will end up in, we believe, a significant inventory overhang next year. And that will be cleared by cyclical price cuts. Now, in terms of monetary policy, and this is where, and fiscal policy, this is where you and I discuss and debate a lot, Art. I remember after 0809, I was sure that the monetary easing would unleash, and fiscal policy easing would unleash inflationary forces. And I was wrong. What had happened was, and I know you and I joust about this, but what
I was wrong too, by the way. If you saw my piece in the Wall Street Journal, I made an utter ass on myself, but at least I know it and I learned from my experience.
So velocity, which I know you consider only a residual, but velocity went down. So the rate at which money turns over went down. People were scared. And we know from the 70s, it is when velocity picks up and when consumers and businesses try to get ahead of price increases and interest rate increases by buying now, that we see an inflation problem building and moving into wages as well. We are at a very important moment right now. Velocity is stabilized. It's ticked down in recent months. And I believe it will continue to tick down because what I just gave you was a deflation story, a secular deflation story, which, if we're right at how powerful this story is, will mean that velocity will continue to fall because prices are going to fall. And interest rates are falling. I think interest rates, you asked me the other day why I thought real yields were negative, 10-year yields negative. Do we really believe real GDP growth is going to be down negative for the next 10 years? I think there's a lot of mismeasurement right now taking place in the nominal GDP accounts. And if we're right, these statistics, having been born in the industrial age, do not account for the digital age. So that probably means that real GDP growth is higher and inflation lower, but it's very confusing. I will give you that because the markets are contradicting each other.
Ooh, it is a rocky end to the year, isn't it? We're seeing all three major averages indicate a drop of at least 1% at the open. And Saz, the sentiment this morning is decidedly risk off. A lot of it having to do with the virus once again.
Yeah, and it's been a tough, it looks to be a tough market open here, Julie. Dow down more than 400 points. You're seeing tech stocks still under pressure here. Work from home names doing well. Looks like, it almost feels like mid-2020 all over again, except the broader market is holding up pretty well, all things considered.
Yeah, so we're going to take a look at some of the groups that are most affected typically by COVID in just a moment. But here is the opening bell on this Monday. And the folks at luxury brand Zegna are ringing the opening bell this morning. They're going public through a SPAC deal today, and we are going to be joined by executives from that entity just a bit later on in the show. Interesting. One of the first, I believe it is the first Italian luxury house to list here in the United States. So again, here this morning, we are looking like a drop at the open. Combination here of virus concerns and what kind of economic impact that is now going to have, and what appears to be the death of the Build Back Better Act at the hands of Joe Manchin. So that last bit of economic and fiscal stimulus not coming through. And so as we go now into 2022, we know that monetary stimulus is going to be ebbing as the year goes on between the wind down of the Fed's bond buying program and, of course, interest rate increases that are expected to come. And now we know the fiscal stimulus that maybe was going to come through is not, in fact, going to come through. Then put Omicron on top of all of that, and you've got a downdraft in markets here right now. So we want to circle back to some of the usual contenders when it comes to stocks that see weakness when we get virus resurgences. Travel stocks, of course, a prime example of that, and we are indeed seeing selling in that sector this morning. Carnival, by the way, also just out with numbers. I haven't had a chance to go through them yet, Saz. I know that you've been looking at them. What do we know thus far about these numbers?
Yeah, that's why I was actually looking down right now at my notes here and not at the screen here, Julie. And Carnival, interesting results. Now, we just talked to Carnival CEO Arnold Donald last week telling us, really, I think, striking an optimistic note. And I'm seeing that a little bit here in this release. Carnival noting advanced bookings for the second half of 2022 and the first half of 2023 are at the high end of historical ranges and at higher prices with strong demand and pricing. So Carnival noting that. Also noting total liquidity, $9.4 billion at the end of the fourth quarter. Those are positive. But again, Julie, can those bookings stay at those levels given everything we see with Omicron? You know, I flagged this morning here, you see a ship coming out of Royal Caribbean coming back from its travel with 50 passengers that had COVID. So can these bookings stay strong, or do you see customers cancel like they were back in 2020 when the pandemic was really raging forward?
Yeah, it does feel like whatever Carnival would say today is going to be overwhelmed by these virus headlines, right? And the headlines on that Royal Caribbean cruise as well, because the question is, if we're seeing these new resurgences, is that going to make people again think twice about booking cruises? That seems to be reflected. That sentiment seems to be reflected in what we're seeing today in the stocks. And then, of course, if you look at the airlines, the hopes that business travel was going to come back, that international travel was going to come back, and that it was going to help these guys, because we've already seen a recovery. But as we know, the last little way to go has to do with business, has to do with international. And you know, this latest surge of Omicron really seems to put that to rest, the idea that that's going to come back imminently, right? And again, that's reflected in the stocks this morning, Saz.
Well, Julian, that's the other problem here. We are in a little bit of a vacuum in terms of corporate news releases. You had a lot of companies present at investor banks earlier this month. Some have had investor days, analyst meetings here, come out with guidance. Those companies, you could really probably no longer rely on those results or that guidance, depending on the company. I look at Delta. Delta came out last week, investor day, very upbeat guidance looking out to 2023. But can you believe that guidance in light of new incoming information with Omicron? The answer is probably not.
Yeah, that most definitely the problem here. Now, the flip side, the other side of the coin, right, is that if we are back to the pandemic trading playbook, travel is down and work from home stocks are up, maybe, that we're seeing a little bit of a comeback of that kind of a trade here. Oh, actually, I stand corrected. We were in the pre-market, but that seems to have faded away. Interesting here. So Zoom is now little change. It's a little change to the upside, but not doing great. DocuSign's still down. Peloton's down. I mean, so this is not necessarily trading the same way that we were seeing things trade in the beginning of the pandemic, Saz.
Well, Zoom, I should now a little bit in the green, Julie, up 0.3% according to the site. So there we go. But look, Zoom shares have rallied about 8.5% over the past 5 sessions. We have seen that bid go back into a lot of these work from home names, and it does make sense. So you're seeing so many office returns being delayed, and Zoom is the platform that you're probably going to be using because you've been using it throughout the pandemic.
Yeah, I guess so. Although, again, that's only 0.5% increase, even if it's coming on the back of some gains in recent days. And then the other theme that we have to talk about as we talk about the virus is the theme of the vaccine makers and treatment makers, right? And we got the news this morning from Moderna that it had seen some success in its booster against Omicron, following on the heels of Pfizer making some similar comments, although it seems as though Moderna's booster is even more effective against Omicron. So those shares are trading higher by 7%. That's one to watch this morning. Also this morning, we are watching all of the vaccine stocks with the exception of Johnson & Johnson. They're trading higher. And then Novavax as well having some news this morning, getting a positive recommendation in the European Union. Novavax, its COVID-19 vaccine. And there was a report from Reuters this morning that Novavax is due to begin deliveries of its vaccine in the first quarter. So not only is it close to getting that full approval, it is ready to deploy that vaccine. So those shares are benefiting as well. So, it remains unpredictable. I think it's safe to say, as we watch Zoom sort of vacillate here. One of the other themes that you've been really focused on is the FANG stocks, and they continue to sell off as well this morning. You could have blamed it on interest rate outlook at one point, but rates are not doing much of anything, and those stocks are still down.
Yeah, I mentioned this in the morning brief newsletter, Julie, too. It's hard to find a catalyst on the positive side for some of these FANG stocks here, at least into the early part of next year, when you could see fund managers step in here and try to pick some short-term bottoms in the like of Facebook, Amazon, Apple, or I should say Meta, Netflix, Google, and some of these other big cap tech names. But I do want to go back to J&J. J&J shares, keep in mind, Julie, this is a company that is trying to split itself up during a pandemic that is clearly not going away and in many instances getting worse. I mean, that's a tough thing to be pulling off here. And I think that's why you're really not seeing J&J shares participate of late in this broader rally in the vaccine names.
Congress. Let's bring in Meera Pandit to get some perspective on all of this. JP Morgan Asset Management Global Market Strategist. Meera, good morning. It's good to see you, even on a morning where everything's in the red. If we can tease out the virus impact on the markets and the now no more fiscal stimulus impact on the markets, how are you thinking about these two elements and their weight in the selling that we're seeing today?
Ultimately, we're seeing broad-based sell-off in risk assets. But ultimately, if we think about the longer arc of time, I'm not sure that these are going to meaningfully change our outlook for 2022 in terms of investing. On the virus side, certainly that is a market driver this morning. But ultimately, what we've seen with prior surges and prior variants is that market sell-off tends to be somewhat contained to a period of time. So we do expect that as we get better and better at dealing with some of these challenges from an economic and market perspective, things will likely settle down despite some of the public health challenges we have ahead. And when we think about Build Back Better, look, we are likely to face a fiscal cliff regardless next year with less fiscal spending than we've seen over the last 2 years. But the Build Back Better was expected to be phased in over a number of years. So while it will be somewhat of a headwind for growth, I think it's right now very much an indication of sentiment more than anything.
Meera, this is going to be a volatile environment into end of the year, maybe to the front part of January too as well. Is this in this environment? Do you pay up to own quality names and then lower your risk, lower your exposure to other riskier names?
we're certainly not advocating for major portfolio changes. And really, we've been gearing towards quality for quite some time now, given the fact that we've had a really strong recovery throughout 2021, very robust earnings. And while we expect that to continue to some extent in 2022, we're going to want to be selective and really suss out the areas of the market, whether it's value or growth across a number of different sectors that are gearing towards more higher quality earnings and areas where certainly margins can hold up and companies have a bit more pricing power.
Mira, there seems to be this a little bit of a bubbling of sentiment that the Fed is not necessarily going to be able to meet its projections for the number of interest rate increases next year. Do you think it's too early to make that kind of a conclusion?
It is still a bit early, given the fact that ultimately we're likely to see the economy move from recovery to recovered next year. And so the economic environment we're facing today is likely to be different in 6 months' time. I would say that with a taper that's likely to conclude around March and potentially rate hikes on a quarterly basis starting in June, it does run into the potential challenge that because monetary policy acts on a lag, we could see the real impact of that tightening collide with a period of slower consumer demand, slower growth, breaking inflation. So there is somewhat of a risk of a policy error, which means the Fed is going to want to be very data dependent and very cautious next year in how it does approach a potential tightening cycle.
And Mira, what would you need to see to become a little more defensive on stocks?
I think we need to see a more meaningful turnaround on the earnings perspective, because ultimately we're still likely to experience pretty solid growth next year from an economic perspective, mid-single digits in the first half of the year, slowing down closer to 2%. But the earnings picture is still likely to be pretty robust, much more selective. Again, not every company will experience the nice bounce back that it did this year, but we'd really have to see a meaningful deterioration in earnings and margins, and also a very meaningful deterioration in consumer demand. Whereas while we think that's going to wane, consumers are still fundamentally in a good position, and businesses have decent tailwinds in terms of the profits picture. So that's really underpinning some of our support for being still pretty pro-cyclical, but balancing that out with some degree of growth in stocks next year.
We are going to jump right into this with a well-known friend of the program. Let's bring in Paul Schatz, Heritage Capital President. It's always good to have you here, Paul. I'm looking off to my other computer because I'm just betting we're going to accelerate into the close with the selling. And what I think a lot of us want to hear from you is, because you tend to look out further than those of us who are more short-sighted investors, but we keep saying hair on fire Omicron, and you say this is not necessarily an Omicron sell-off. Help us understand what you think is truly happening.
Always good to be with you. Thanks for having me. So, as you know, there always has to be this assigning of blame and credit. So Omicron's the easiest thing to blame on the market sell-off. But when you look at the sectors and you look at what's declined, not just in one day, but over the last couple of days, the work from home stocks aren't exactly lighting the world on fire, which if this really was about Omicron, you'd see a complete bifurcation of the market. You don't see that now. The selling has been broad-based today, and it was disappointingly broad-based on Friday. So when you look a little deeper, today you've got industrials and materials taking on the chin, but industrials and materials on Friday were one of the leaders. So to me, this is not Omicron, and it's certainly not Build Back Better failing. This is just continuing on from what Jay Powell said and what the Fed did and what we expect to happen in 2022. The Fed is tightening. You want to call it quantitative tightening, or you want to assign some cute name to it. Anyone could be my guest. But the bottom line is there's going to be less money in the system. And when there's less money in the system, the rising tide no longer lifts all boats. The decline is not the death knell of the bull market, but we shouldn't be having it seasonally. This should be a seasonally strong period, and so far it's not.
Paul, this is Emily here. You mentioned that Omicron is perhaps just the scapegoat for today's decline that we're seeing across stocks. But at the same time, we're seeing the travel stocks getting hit again. We're seeing crude oil under pressure, energy, the cyclical sectors. So should investors be thinking about the Omicron variant and these renewed concerns over stay-in-place behaviors when they're thinking about where the stock market might be headed in 2022?
So I will say absolutely, positively not. Omicron is, if you look at all the charts from all the quants, it's happening much faster. We've got, on a percentage basis, less hospitalizations, a lot lower death rate. I'm not trying to minimize the health crisis, but from a market perspective, Omicron is going to be fleeting. So you mentioned the cyclicals were down today and they were leading on Friday. When you combine them both together, it doesn't equal a market that's look at the tech sector. I mean, frankly, the tech sector has been under pressure. If Omicron really was the reason behind this, tech would be, I hate to say it, this little bit of a safe haven. You said 2022. Now, I do think 2022, it doesn't have to be from the get-go on January 3rd or 4th or 5th, but tech is not going to be the place to be in 2022 as it was in 2020 and 2021. So I agree with you there. We're going to have some probably massive sector rotation in early 2022. I will argue that things like utilities and staples and biotech will get a lot more attention, some of the lower volatility areas in 2022 than they have seen in a long time. But I don't think we're going to have a repeat. Unfortunately, I don't think we'll have a repeat of 2022 stock performance.
For most of us, it really just boils down to how do I make money, next year, 2022. And you've just alluded to that in some respects when you talk about sector action. You've also, I think, pointed out to your clients that perhaps small cap may be some place to focus. But for those who are seeking shelter right now in bonds, even with interest rates going up next year, would that necessarily be the best place to be going? Because you're going to wind up getting burned, aren't you?
That would be conventional wisdom, Adam. But let's remember, bonds, although the bond market itself is only going to be down, let's just round and call it 2.5% in 2021. And with inflation really at not levels seen since the early 80s, the bond market should have been hit a lot more. I will go out on a limb. I'll be a contrarian. I'm going to say bonds get rewarded in 2022. I know I don't love bonds. I wouldn't buy them for the next 3 to 5 years. For the next 2 to 4 quarters, would I trade bonds? Absolutely. And I think you can go back to some plain vanilla, bond funds. You may not make 10%, but I don't think on a risk reward basis, you'll be as worse off as you will in stock. So I think bonds are going to get a bid in 2022 because I feel strongly, as I mentioned with Alexis on October 28th, there's a 5-month period where I feel strongly that inflation is peaking. You're going to have inflation going down next year, the Fed raising rates on the short end of the curve. And most importantly, I think GDP growth is going to come in a lot. I think GDP growth is going to be disappointing next year. So all that's a recipe for bonds doing okay.
Paul, you alluded to the Build Back Better plan, which potentially is going to be scuttled in your first answer here. But Goldman Sachs economists earlier today downgraded their quarterly GDP outlook for next year in the event that this bill does not pass without Senator Joe Manchin's support. How much does that lack of additional government spending impact your outlook for the economy and for stocks next year?
For me, that was already baked in the cake. If I didn't think it was going to pass and it didn't pass, I can't believe that someone at Goldman Sachs went to sleep on Friday with this really bullish view of the economy for 2022. And because Build Back Better didn't pass, which was going to get boiled down to somewhere around $1.5 trillion, and all of a sudden they woke up and they downgraded on Monday. That to me, that seems kind of odd and curious. So is it going to impact my thinking? Well, I've thought about it for a while, and I didn't think it was going to pass in its current form Friday. So could they put something forth next year? Of course they could. They could put forth a little tiny bill, but don't forget, you only get a couple of bites at the apple if they're going to try to put it through reconciliation, which is, so you've got a bunch of different factors floating. But the idea that taxes across the board are going to go up, I think that's pretty much shelved. You're going to get closer to the election. Could they put forth a small bill with some spending in it? Yes. Do I think it's a needle mover? No. And I don't think it's going to juice the economy.
We want to dig back into the markets here. And for that, we're going to bring in Ted Oakley. He is the Oxbow Advisors managing partner. And Ted, what do you make of the price action today? Because I'm looking at the markets here. Usually at this time of the year, we don't have that much volatility. Markets are gearing, market participants gearing up for maybe a Santa Claus rally, people thinking ahead to 2022. But we got some headwinds right now.
Well, Jerry, we do. You know what happens a lot of times, you come into the very last part of the year and people have, they've etched some really good gains, and all of a sudden they're starting to think, okay, hey, well, maybe they get away from me. And I think that's part of what you're getting right now. I wouldn't necessarily say that would probably, last for more than, a few weeks or so, but it could. I think the biggest thing right now is there's a number of headwinds coming at us now. One is probably all of a sudden they're pricing in, peak hawkishness from the Fed. And secondly, probably not going to totally go away with this inflation thing. And lastly, you just had such a speculative market that it's easy for it to start getting some selling. And so that's where I think we are at this point.
And sir, what happens to the growth story next year as you look at your outlook for 2022?
Well, I think what happens for 22 is that the growth will slow. I think it has to. I think between inflation and a lot of programs are cutting off. If you look at a lot of the money that would normally go to consumers, there's the SNAP program, which is sort of an extra food stamp thing that's been going on. That goes away. The child care tax credit goes away. You have to start paying back your student loans next year. All of that gets sucked out of that economy right now. And when you get into that and start looking at it, in addition, you have inflation. So consumer spending probably is where it takes it on the chin. And that's why we forecast really slower times when you get into 22.
So thinking about that, what kind of sectors, industries, styles are you looking at for at least the beginning of 2022? How are you positioning yourself to weather the headwinds that we're talking about that are on the horizon?
Well, Jared, we have three strategies, which are a growth strategy and an income strategy that's designed to beat the bond market, even though we don't own any bonds in it. And then we have a really conservative strategy. But let me just say in the growth strategy, we have about 25% liquid in there right now, and we will never apologize for holding cash. It's always been a great thing for us when times got poor. But we own companies in there that we think can do well even through a poor economic period. If you look at a lot of the companies we own, we think they can move 15% a year. I'm talking in terms of their numbers, maybe not the stock, but they can make 15% a year or so for the next 5 years. We like that kind of stock, all right? In the income side, we still like the gas pipelines. We own a lot of preferreds. We think they'll hold well, especially the too big to fail bank preferreds. And you'll see we own about 4 or 5 REITs primarily. Most of those are medical REITs because we don't think they would have a problem with the economy. And so if we mix all of that together, and we've got a lot of liquidity there too, about 35%. And we made a shift on the conservative fixed income account. We haven't bought any bonds longer than a couple of years until starting about 6 weeks ago. And what we've done now, and people have to realize this, when you go into a flat yield curve, you need to own some things short because those yields are going to crank up with the Fed, but you also own the long bonds because people will look at that and say, hey, we're going into a recession. I want to own the very long treasury. And so we have some of that as too. So that's how we're sort of positioned right now.
And Ted, what happens to the profit margin story next year? Because this year earnings were the big winner, right? But as inflation continues to, persist, what happens then to companies who will feel the squeeze in their profit margins?
What should happen is we would get I think they know that now. I've seen some earnings come out the last few days of companies that normally consistently beat, and they've had trouble. And I think what happens next year is just a continuation of the fact that they've just finished peak margins. I don't think those margins will be there again. And so as they go through the quarters of next year, I think two things happen to them. One, their prices go up, and two, probably their wages go up to an extent. And when that happens, it comes out of those margins, and that's and actually the revenues go down. And so all of those come together. And I think a lot of those companies will suffer that when you get into 22.
Let's turn our attention back to the markets. We did see a big sell-off yesterday on those Omicron fears, with the Dow falling more than 400 points, but a real reversal today in the session with the Dow up nearly 400. Let's bring in Kevin Mon, Hennian & Welsh CIO, and Liz Young, SoFi Head of Investment Strategy. Liz, try to make sense of this for me right now, because I'm looking at some of the stocks that are moving today. The vaccine stocks are down. The airline travel names are back up at a time when we have seen globally new restrictions go into effect.
I think this is a perfect time to remind everybody that the market is a leading indicator. So the market is going to go down, the market is going to bottom before the bad news peaks. We likely haven't heard all of the bad news yet. We certainly haven't hit a peak in the Omicron cases. But what we're seeing in the action today is that we've had 3 days of a sell-off. And some of that, I think, was overdone, especially in a lot of these areas that are positioned to do well in a reopening environment, or in an environment that I think we'll see in 2022 when we've started to learn to just live with this. And you have to have some money in the market in areas that should do well in that particular way. So airlines is one of those. Cyclicals are more of those. When we look at the pattern in the market today, I think this makes sense for what's ahead for the next 6 to 12 months.
Yeah, Kevin, let's jump on that then. If we are looking at the market as a leading indicator, what are the investment flows today telling you about what investors are anticipating down the line?
Sure. And the two biggest uncertainties for investors right now clearly are Omicron and what may come next with respect to COVID-19. And then, of course, what the Federal Reserve may or may not do in 2022. As we learned last week, Akiko, in all likelihood, we are now finally entering a rising rate environment with 3 potential rate hikes at 25 basis points each next year. But what does that lead to? That creates investment opportunities from our perspective. In fact, one area that we happen to like are financials. Financials historically have performed well in rising rate environments when economies are expanding. Considering, of course, the Federal Reserve wouldn't be raising rates if, in fact, the economy wasn't continuing to expand. In fact, Akiko, and I'll say it here, right now, our theme for 2022 is still growing, but yet slowing. And those opportunities for growth in the stock market are going to be a little bit harder to find than they were in 2021.
Yeah, I want to get back to that theme of still growing, but yet slowing. You mentioned financials, though. What specifically are you watching? Is it the major banks, which we have seen rally on the back of the Fed decision, or are you looking at other spots that you see real opportunity right now?
Great question, Akiko. And we happen to just launch a brand new Premier Banking Opportunities Trust here at Smart Trust, focused on smaller cap regional bank, community banks, and mortgage and thrift institutions. That's where we see the real opportunity for growth and also M&A potential in the years ahead. If the economy continues to expand, if in fact interest rates stay at record lows, even though we're in a rising rate environment, going all the way out to 2024, the Fed may only, I put in quotes, raise rates by 2%. That's still going to remain at historic lows. So banks should operate well in that type of environment.
And Liz, going on that theme of still growing but yet slowing, when you look at the trajectory next year, the market has obviously navigated Fed rate hikes before, but this is kind of a new one here in that we are seeing slowing growth, and yet those hikes are projected to come. Number one, are you still anticipating 3 rate hikes? And number 2, how significant is the risk for a misstep, especially with so many other variables that aren't necessarily in the Fed's control?
I think the last part of that question is the important part to focus on right now. One thing that investors should be watching, and something that's been catching headlines a lot, is the spread between the 10-year and the 2-year Treasury. Now, today, that line is steepening, meaning the curve is steepening, and that's what we want to see in a healthy economic environment. What I think has been happening on the 10-year is that people are they're fearful of a Fed mistake. They're fearful of a policy mistake. Now, will they hike 3 times in 2022? Sure, it's it's possible. But keep in mind, even if they did, the lower bound is still below 1%. And historically for markets, the first couple hikes are not the ones that are detrimental. It's when you get later into the cycle. Also, something that I would urge investors to watch is the sort of kryptonite for the market is when the Fed hikes rates to a point that's close to where the 10-year Treasury is trading yield-wise. So right now, the market isn't expecting the Fed to get much past 1.5%. I don't think that's any accident, given where the 10-year is, somewhere between 1.4 and 1.5. As the curve steepens, which is what I would expect it to do in 2022, which would be good for financials, I absolutely agree with that take. As the curve steepens, you should see some of those expectations go up, and you should see a benefit to certain parts of the market. Now, there is going to be a headwind on high growth areas of the market. That doesn't mean that they're going to produce negative results. It just means that they're probably not going to be the big stalwart leaders that they've been for the last couple years.
Liz, finally, what do you think is the one risk that you think investors are overlooking right now as we look ahead to 2022? So much talk about the Fed's tightening as well as just where Omicron is headed. And yet I have to wonder if there is that one event that we're not necessarily considering here.
Well, the biggest risks are always the ones that we don't see coming, right? The ones that we talk about are usually the ones that don't exactly materialize. I think what investors need to pay attention to still is the consumer. I think 2022 is going to be a year where fundamentals finally matter again. And when I say fundamentals, I mean especially valuations. I think that 2022 is a time when valuations begin to be the big decision factor. And they haven't been. And, low rates and a lot of liquidity has lured investors into this false sense of security on a valuation basis. And in 2022, I think that false sense of security goes away. So we have to keep a closer eye on those items.
But for a deeper look at the markets this afternoon, we're welcoming in Anna Han, Wells Fargo Securities equity strategist. Anna, thank you so much for joining us. First, want to ask about the trading action that we're seeing this afternoon. What do you think is driving this recovery rally that we're seeing today?
Well, I think you naturally are getting a little bit of this bounce after we've had a couple choppy sessions. But, also the market is trying to really price and digest the new information we're getting here. We had some news on Build Back Better getting delayed. We have more information on Omicron. These are the things you're seeing combined with a low liquidity as we get into year end. So you're not surprising to see the volatility.
And the president in his address to the nation mentioned another bank which said that without Build Back Better, we'd see GDP drop next year. But then he said, the last thing he said as he was walking away regarding the potential to do something, he said, we will do something. Do you think the markets are picking up on that, or will that come next?
I think most of us expect that it's not really completely off the table. It's the can got kicked down the road here. But for us, our equity projections were baking in no impact from Build Back Better, or not no impact, I should say. We weren't expecting it to pass quite yet because we've seen the political landscape develop. You saw what happened with the off-cycle elections in Jersey and in Virginia. So it looks like that inter-party strife is going to be a big theme next year.
And again, going back to the market action that we've been seeing over the past couple of days now, we really have been seeing the seesawing between cyclical leadership and then, of course, tech and growth leadership. And of course, we are seeing the NASDAQ composite and those tech names outperforming today. What do you think is ultimately going to be the leadership as we look into 2022?
Our projection for 2022, it's going to be a barbelled approach where you're going to want that cyclical exposure. We do think that cyclicality will lead. As you start getting really late cycle dynamics, you start seeing real yields coming up, then that cyclicality is going to be important, but it's going to be different than just a value approach. The difference here is we actually want high quality. When you have accommodation coming off the table, you see credit liquidity being reduced, you really want to be leaning more towards your lower leverage, wider profit margin sort of company. So we need a combination of both.
I'm going to throw out a company. You don't have to respond directly to that, but I'm asking for examples like Verizon. That stock has essentially been flat for years, but it's a dividend payer that people love. But where are their earnings really going to grow? So when you talk about cyclicality and then finding high value, where would you send me as an investor?
Well, I'll actually qualify that a little bit here. We want cyclicality, but we want to not pay too much for the high quality price. What we want to avoid here when we look at corporates is we don't think that GDP growth is going to slow down so much that you need to pay these exorbitant valuations for. That's that growth at any price style that we've seen. But when you have these companies that are opportunities such as that have cyclical exposure, that are reasonably priced, and they have good balance sheets, that's that sweet spot we're looking for.
When do you see liftoff taking place here for the Federal Reserve next year, and how do you expect stocks to react to that?
Well, what we have seen, the Fed has been very clear with its communication. It actually accelerated tapering, which was something pretty expected. And naturally, as you accelerate tapering, you see that rate hikes are being pulled forward. But in that respect, what's interesting is it does help perk up real yields. You see very traditional late cycle dynamics of yield curve flattening, and you do see cyclicals sort of take the lead. But what's still murking the waters is we have the Omicron issue going on. And until we get more information, I think that teeter-totter you mentioned earlier is going to continue, and we're going to see more equity volatility next year.
Climbing to 5,330, says our next guest. John Stolfus is the chief investment strategist at Oppenheimer. John, always nice to see you. Listen, we've talked to you many times throughout the years. What is it like to be the biggest bull on Wall Street during these volatile times?
Well, I've got to say, first of all, thanks for having me on the show, Brian. I've got to say, for us, it's we look at the fundamentals, and overall, the fundamentals have been remarkably supported by the Federal Reserve, as well as by the response to Federal Reserve liquidity via business, the consumer. It's been a remarkable thing. Everybody steps up and does their job, but the Federal Reserve, the most important part. And then we've even had, we believe, overstimulation by politicians, both administrations. And look what we've been able to accomplish, showing remarkable resilience.
John, walk us through this call a little bit. The way I'm seeing it right now, we may have 1 or 2 rate hikes next year, potentially. I'm seeing events canceled into January because of Omicron. What gives you the optimism on the S&P call?
Well, the one thing, first is the events being canceled and all. We've been through this before. And I think the president very well pointed out in his talk, I guess it was last night when he was on television. I think essentially this is not March of 2020. This is with all the experience that society, business, the consumer, et al., have experienced. We've been through this before. We can expect a certain element of slowing in segments of the economy that will be shuttered or partially shuttered. But gosh, we've got, technology and science have brought us to the dance, and they'll take us out of the dance when it comes into the next new normal.
Again, love the optimism that there's light at the end of the tunnel at some point, even if it's a little bit further off than we thought. Let's talk a little bit more about the fiscal stimulus side of the equation, which you just mentioned as one of the things that has helped the U.S. economy be so resilient. As you know, of course, Build Back Better doesn't look like it's going to pass, at least not in the very short term. Is your call contingent upon another tranche of stimulus? Does the U.S. economy still need it?
It actually isn't contingent on another round of stimulus. We think that the economy has shown that it is in good stead now, and the Fed can afford very well to begin the tapering process at an accelerated pace, end it in 3 months into next year, and then actually begin considering, when it's going to be tweaking its rate upward on the Fed funds rate, its benchmark rate. We do understand, from the data, and we're not epidemiologists, of course, but from the data that's coming out from the medical community, it does appear that this variant, it will not be as disruptive as COVID-19 was, or even as disruptive as Delta was. So we'll have to see. Well, it's much more infectious, and that's very worrisome. But it does appear also, just when we talk to people, people want to get out. They want to get back to work. They want to get the kids back to school, but they're also experienced. You know, it's like Jimi Hendrix used to say, have you ever been experienced? Well, we've all been experienced with this COVID thing, whether or not, if we've gotten it or not. I fortunately have not, at least not yet, and I hope not to get it. But, you know, we maneuver, we navigate, and it's been remarkable. But again, it's been science. It has been technology, which has enabled many businesses that can deliver their products or services via technology, and it all to achieve really good results. And we've got to think that resilience will follow through, even though we'll get some choppy waters in here. And I think the market has reflected that of late.
So let's talk about consumer resilience then versus market resilience, right? Because part of what has fueled the stock rally this year has been that dual stimulus, right? Fiscal and monetary. And next year, both of them are fading. I mean, the fiscal is already fading, right? And monetary stimulus is going to fade. So what gives you the confidence that we're going to still see a lot of money coming into the market? I mean, and that said, you're not looking for a huge rally next year. You're just looking for a bigger rally than most of your peers. But what gives you the confidence that we're going to continue to see money come in?
Well, we think, for one, we think in terms of business through whether it's robotics on the factory floor, algorithms in the offices, is generating greater efficiencies in terms of maintaining margins and capability to improve cash flow and profitability. But within the consumer, over the 38 years that I've been in this business, it's very risky to bet against the American consumer. The American consumer will shift what they buy, but the American consumer is determined to buy. In terms of the withdrawal of liquidity, we just think it's been fairly well proven by the high degree of inflation that we've experienced, close to 40-year highs in inflation, that indeed, when we look at it, there probably is too much. That's evidence that there was just too much stimulus, and it's time to get back to work.
John, within your call here, which sectors do you see really outperforming?
Favorite sectors here right now remain what we've held to be this year, where we're accumulating positions in these. In terms of our outperform rated, it would be technology, which we expect will not be hurt by higher interest rates, at least the higher interest rates that we envision. We don't see the Federal Reserve slamming on the brakes, but simply pumping the brakes. We also like consumer discretionary, which offers a mix of growth and value. And then we like financials, which we think will benefit from a higher yield curve. And we think the industrials are going to do better. We've already seen indication that investors are beginning to favor them, or the latest pullback, they did hit them. But we think they're going to get a stronger appetite for industrials moving ahead as the infrastructure program, the side that was voted positively by both sides of the aisle, as that comes online, we think that'll be good. Overall, our call is go for growthier value and GARPier growth. And the reason why we say GARPier growth, it's growth at a relatively reasonable price when it comes to growth.
And John, there are some very large, reputable firms that compete with yours out there with calls on the S&P 500 flat to negative returns next year. Where do you think they're missing the boat?
Yeah, some of those which I've worked for, by the way, in the past. I've got to say, I'm not going to mention any names, but, listen, we think that what their call right now is similar to the fourth quarter of 2018. And it was the wrong call. It missed the fact that the thought in 2018 was that the Fed would continue to raise rates blindly, and it didn't. It pivoted. And we think the Federal Reserve remains highly sensitive. This is not Alan Greenspan's Federal Reserve, where they would slam on the brakes or they'd flood the system with liquidity, either or. This is Bernanke legacy. It's Bernanke to Janet Yellen passing on the ball to Jerome Powell. Jerome Powell, we believe, is not the greatest communicator in the world. He's a little stiff, but we think he's a straight shooter, and we think he's very sensitive, and we think the whole Fed is, whether it's related to employment or inflation. There is vigilance on both ends of that, and we think they're going to navigate this very well, and it will positively affect business and the consumer.
Here at Yahoo Finance, like most financial journalists, love our charts, and I'm sure you do too. We got to tell you, what are the most important charts that you want to watch next year to figure out the direction of the economy and the markets? Well, for that, we need a little help from an old friend. Sam Rowe is the editor of the TKR.co and wrote up some of these charts and flagged some of these charts for us. Sam, good to see you. Happy holidays. Let's take a look at the one of these that you flagged, and that's job openings, which jolts, in other words. This thing has gotten sort of unprecedented attention over the past couple of years. It never was the primary chart, and it's just gained a lot of importance.
Yeah, no, it really has. It's I guess, you know, the JOLTS, the job openings and labor turnover survey, which sort of lags the official employment report by a month, has gotten a lot of attention because it's captured all the turnover that's been going on, you know, in the labor market since the beginning of the pandemic. You know, a lot of the other metrics like quits rates and all this stuff has been getting a lot of attention, but job openings, you know, is just incredibly interesting. I mean, you know, you think about the state of the economy right now and the stock market and earnings, and you do hear about a lot of positive things happening about how consumer spending is, you know, back to new record highs and GDP is back to record levels. But we have 11 million job openings, and job openings, you know, an employer doesn't put out a job opening unless, you know, they're trying to fill some sort of unmet demand. And so job openings is an incredibly bullish leading indicator in that, you know, there are a whole lot of businesses saying that we need more people to, you know, conduct business, to manufacture goods, to, you know, serve customers as they come into our store, or diners when they come into our restaurants. So I think this is going to be an, you know, very important one to watch, because as long as those job openings are high, it's signaling to us that you know, there's still a lot of demand that's being unmet in the economy.
Sam, I know you're also watching delivery times, because really one of the stories of this year has been supply chain problems.
Yeah, I think, you know, delivery times probably captures, you know, the supply chain issue, you know, most succinctly. And yeah, they're all elevated. Like, you know, the indicators are starting to turn lower a bit, but they're still extremely elevated. And one of the things that's really interesting about supplier delivery times is it has a pretty tight correlation, like that specific chart that, you know, shows that elevated level based off of manufacturing and purchasing manager surveys, is it's very tightly correlated to inflation rates. And so what that suggests is, you know, as supply chains improve and those delivery times get better, we could see some, you know, significant relief in the inflation rate.
So there are lots of different ways to sort of slice and dice that stuff, right? To try and figure out what's happening with the supply chain and the effect it's having on companies. And one of your other charts is another side of that, another nuance of that, the inventories to sales ratio, because we know that inventories have been falling. This is, I hadn't seen this particular chart though. This is a cool one in terms of looking at that ratio.
Yeah, inventory to sales is just, again, it's another one of these stories that, you know, I guess it's probably something that the consumer sees a little bit more. When you go to a store and, you know, they don't have something in green, so you buy it in navy, or they, you know, the bulk size, you know, oatmeal isn't for sale, so you buy the individual packets instead. Yeah, I mean, this is all a result of both a combination of tight supply chains as well as, you know, really strong demand from, you know, consumers and businesses. But, you know, what's really interesting about, you know, inventory levels and inventory to sales ratios is, you know, even if you have a situation where, you know, the end demand is, you know, cools off a little bit, businesses, stores, warehouse, you know, all these you know, entities that have deflated inventory levels are still going to need to restock these inventories because they just want to be better prepared for their customers when they do come through those doors. So, The fact that inventories continue to be depressed is just incredibly another one of these really sort of bullish looking leading indicators. Because even if, even if that end demand cools, businesses still want to make sure that they have stuff in their stock rooms and, for when that demand does return.
This is making finance fun, Sam. It feels like we're revealing toys on live TV here. I know you're also watching profit margins, and to me, listen, I'm surprised. Profit margins this year have remained so resilient. I mean, look at all the inflation we have seen: labor, cost of goods, you name it.
Yeah, no, this is probably, one of the crazier stories of the year. And you guys were just talking about, what's been going on with the stock market and how it's been surging. And, behind stock prices is earnings, and, underlying those earnings is profit margins. And when profit margins are strong, all things being equal, that earnings growth is going to be a lot more robust. And so, yeah, it's really incredible, especially with so many executives and businesses and, trade group representatives and stuff, all year has been screaming about inflation and how rising costs of goods and rising wages and all these things that are, pressuring costs, ultimately didn't affect the profit margins. Because of, there's a number of things going on with these companies. They're figuring out how to squeeze more productivity out of, the few people that they have working for them. I mean, again, we just talked about job openings, right? They're still figuring out how to, deliver goods, even though, they're sort of stretched for capacity. So they're getting more, operating efficiency out of their existing businesses as demand returns. But the other thing that, is just one of the more triggering, upsetting things that people hear about is companies have pricing power, that they are raising prices and they're passing these increased costs off to their customers, and the customers are taking it. We've read all the stuff about, higher incomes and rising wages, obviously excess savings, and then, corporate cash piles and stuff. The, customers, businesses, consumers, they're going to be really upset about, how much the price of what they're buying has gone up, but they're buying it anyways. And that's something that's come through in retail sales data. It came through in today's consumer spending data. It's just incredible. And, corporations are very smart about this. They are aware of, what's going on with their customers. And so they're raising prices, and, the sales are holding up. And so they're going to keep doing that until they get some actual pushback.
It's interesting. You mentioned all the different constituents that have sort of been noticing that. Congress has been noticing it too. We've gotten a little bit of political rhetoric around that also. But the thing is, as I look at that profit margins chart, you can't help but think it's going to keep expanding next year. I mean, we've been talking about peak profit margins, right? We talked about that earlier this year. But if component prices, if inflation on the wholesale level actually starts to go down, which there are plenty of predictions that it will at some point, and these companies don't cut their prices, those profit margins are only going to expand, right?
Well, I think the way, there was, this is something that's been coming up with a lot of, the strategists, 2022 outlook notes, that, everything from relief on the supply chains, jobs being filled, all these things that, become a little bit more disinflationary. And, of course, we're also talking about, tapering QE at an accelerated rate, and the Fed raising interest rates potentially next year. All these things there's a lot of, forces that look like they're going to bring some relief to cost pressures. But I'm not quite sure that necessarily means that profit margins are going to, continue to expand or hold up. It's possible that, if costs do start to come down, then, businesses, as they look to, steal market share from their competitors, might get more competitive when it comes to pricing, so that they can just get a bigger share of the market. So, I think profit margins ends up becoming a wild card. But I think what's going on with elevated profit margins right now is probably, companies, trying to, be a little bit cautious, even though it means, potentially foregoing on stealing market share from their competitors.
Sam, you're up 24/7 pretty much studying markets and stocks. What's the biggest thing you learned about markets this year, or just reminded about markets?
I think probably the most interesting. I think there were two things that really, kind of jumped out this year, Bank of America strategist Savita Subramanian, had this really nice quote, a couple of weeks ago, and she said that something along the lines of, it's dangerous to wager against corporate America. So just like we were talking about with, profit margin and pricing power and, all these different things where there's this huge acceleration in earnings growth, is that businesses will figure out a way to conduct business and grow and, enhance shareholder value. So that's one thing that I think was a good lesson for everybody. And the second thing is that, consumers are just relentless when it comes to consumption, right? Like, again, even if it's, there might be inflation, there's, a pandemic out there, there's, I think, particularly when we saw the Delta variant, earlier in the fall, and, this was an incredibly, dangerous variant of COVID. But during that period, we saw, not only did we see retail sales continue to grow, but they grew at rates that far exceeded economists' expectations. And, all that goes to show is that, people, regardless of the dangers of what's going on out there, they're going to try to figure out a way to live their life and consume and experience those experiences, because I don't know what it is. Maybe there's a YOLO or life is short factor, but yeah, don't underestimate, businesses' ability to adapt, and don't underestimate consumers' hunger to consume.
Our next guest has 3 investing strategies worthy of your consideration. Michael Roney is the Chief Investment Strategist at State Street Global Advisors and is here with us now. Michael, happy holidays. Always nice to see you. Hit us with your first strategy.
So I think the first thing investors should do is blend quality and value in the core of their equity portfolios. So here's the thing, Brian. In the early days of the stock market recovery during the pandemic, companies that didn't earn any money did just fine. I think it was indiscriminate buying. But interestingly enough, since May of 2021, companies that earn a profit have outperformed those that don't. And in fact, over the last 3 months, companies with healthier balance sheets, more stable earnings, and dividends have outperformed the market by 6.5%. And on the value side, we expect as the economy recovers, rates and inflation drift higher, those value stocks will continue to do well in 2022. If we can just get past the surge, which I expect sometime in the first quarter, we think value is a good place to be as well.
Hey, Michael, it's Julie. Is there a way that people should be trying to analyze which companies will have, I think your point about profitability is really interesting because, as you say, there was that indiscriminate buying earlier in the year. Should people be trying to look for research on which companies are expected to grow that profitability the most? Or is it a focus more on consistent growth rather than the magnitude of growth?
Julie, I think it's the latter. I think it's the consistency of that growth. So one of the ideas that we have is around dividend growers. So for example, the S&P Dividend Aristocrats Index, for example, we think is a good proxy for quality and stable earnings. That index looks at the S&P 1500 and then selects the companies that have been able to grow their dividends for more than 20 years. So what type of company can do that? Well, ones with healthy balance sheets, stable earnings, lots of cash flow, and low debt to equity. So one of the things that's really interesting is that from 2009 to 2011, we saw some similar return patterns. So 2009, we're in the midst of the global financial crisis, stocks doing well. 10, recovery happens, doing well. 2011, S&P was up about 2%, but the Dividend Aristocrats was up about more than 5.5% above the S&P. You could see something similar here, 2020, 21. Next year could be like 2011 was, and it could be a good year for the aristocrats.
Michael, what what stocks won't have a good year next year?
Well, I think if our thesis holds in that inflation will remain elevated and rates will creep higher as the Federal Reserve begins to tighten monetary policy, I think there's two categories that will struggle. Long duration growth assets, so that's your classic technology companies, Brian, and then also your defensive sectors of the market, your typical utility staples. Now, interestingly enough, in the last month, at least in ETF flows, we have seen a bit of a shift towards defensives, towards staples, towards healthcare, that type of thing. But our view is that if rates and inflation creep higher as the economy recovers, your defensives and your long duration growth assets will struggle a little bit. Doesn't mean they'll be down or big bear market, just means that relative to quality and value, they'll probably underperform.
And you know, when you're talking about the dividend growth dividend growers as well that you mentioned, the dividend aristocrats, are some of those vulnerable too in a rising rate environment?
They could potentially be. I think the key here is that as long as the economy continues to recover and the Fed goes at a kind of a reasonable pace, we still have negative real yields here in the US. So I do think some of those will offset that. I think the risk to the call is that if the Fed tightens too aggressively and real rates pick up, that could be a risk to some of the dividend payers. However, if, as we expect, the Fed goes at a slow pace, well telegraphed, and we still have kind of negative real yields, income will be important. And we do think that the dividend growers will outperform.
Michael, we've talked to you throughout the year. It's been a very busy, hectic year. It really started with a bang in January with the meme stock frenzy. You know, as a veteran in this market, what is one thing you learned about investing this year, and how will you apply it to next year?
Well, I think it all comes down to the earnings. So ultimately, at the end of the day, what drove markets this year was the incredible earnings growth. And so I do think as we think about 2022, some of those risks. So earnings, we all know the great numbers here. S&P 500 up more than 45% year over year earnings per share growth, more than 80% of the companies beating, and by some of the widest margins we've seen in decades. Now, next year, as we pivot, Brian, it is likely that comparables will be tougher. Growth will slow comparably from this year to next year. Perhaps fewer companies will beat, and by a less kind of magnitude, by a smaller amount. Despite all that, earnings growth should continue to be elevated, meaning earnings per share growth for S&P still above 8% on revenue growth of 7%. That should be enough to propel stocks higher, but could be a risk if we do disappoint. So the lesson I learned is that earnings are the primary driver of stock market prices and expectations about those earnings.
I want to turn back to the markets as we continue to kind of reset expectations. Of course, 2021 had its own bits of volatility. And for more on that, very happy to welcome in Mike Bailey, FPB Capital Partners Director of Research, joins us now. And Mike, you know, I guess each day as we wrap up 2021 and look ahead to 22, it's going to be a lot of the same questions of how investors should be poised to take on whatever volatility does roll over. So what's the advice you have in terms of looking into the data historically for what investors should brace for?
Absolutely. So, looking into next year, it's been an amazing 3-year run. I think it's been kind of a three-peat here. We're inching towards 30% year-to-date returns for the S&P. I think as we look to really manage our clients' expectations and really protect investors, we really want to think about, something probably less heroic. Are we going to have 4 years in a row? History actually would suggest that would happen. Historically, you do see these patterns of 4 years of outperformance, but I think, we would anticipate a bit less kind of upside. Historically, markets go up 5 to 10% a year. That's probably more of a base case. You could argue that, last year's, gain is going to be next year's pain, if you will. It may be just a little bit tougher to see this kind of dramatic outperformance. But still, if you look historically, 5 to 10%, that's pretty good. That's well above inflation generally. So, as we sort of think through, where clients have been, where are we headed next, that type of a situation seems pretty reasonable for us. Certainly, a lot of things could happen to make that be better or slightly worse, but that's kind of our starting point heading into next year.
Yeah, obviously, historically, 5% would be outpacing inflation. Not the case in what we've seen this year. When you look at maybe some of those other stocks that you'd be most confident to lean into, though, Talk to me about where you're kind of seeing the best opportunities there. I know you got a couple tech names on your list, including Amazon and Salesforce as well.
Absolutely. So sort of thinking through some of the dynamics next year, one of the issues for us is a possible slowdown in manufacturing. So there are surveys out there, they're running red hot right now as sort of supply chains remain tight. People want their products. There's a lot of manufacturing. If that slows down, historically, some of the cyclicals, manufacturing, energy, that can be a little bit slower. So we're sort of pivoting a little bit more towards other parts of the market, tech, for example, or counter-cyclicals, defensive. So a couple names in that space in the tech area, Amazon, Salesforce, again, very nice growth, very durable sort of barriers to entry. Oh, by the way, valuations have gotten a bit cheaper, for both of those stocks. So those are a couple things that we like. For Amazon in particular, especially if some of these supply chains unwind, they're going to spend less money. So that means more profits. Again, I think that the stock may perform well. Salesforce, a little bit of a hiccup. They did a deal a couple of years ago called MuleSoft. That one didn't perform quite as well in the last quarter. Stock took a hit. I think they've got a pretty good track record of a pretty good execution. So we could see a better performance into next year.
When you know that there are a lot of risks out there that could bring some more volatility next year, what are you looking at in terms of some of those that people should be watching more closely? Obviously, inflation still won. The Fed indicating about 3 rate hikes next year. When you look at the median dot plot, I mean, what are your expectations around what could knock the range from expectations and returns from 5 to 10% on the lower end rather than the high end?
Absolutely. So I think one of the biggest concerns for us, you hit the nail on the head there with the Fed. So investors really kind of, everybody's all in on anticipating some kind of rate hikes next year. I think a more difficult outcome for us and for investors would be a rapid succession, more rate hikes happening more quickly. If you were to see, 2, 3, 4 hikes happening in the early part of the year or in the first 9 months, that definitely is something historically can knock off sentiment for investors. So that's definitely a big concern for us. You can certainly go down the list and look at any number of things. We've seen certainly COVID going up and down in terms of a risk factor. Inflation, as we talked about, really kind of spiking right now. If that remains high or goes higher, that's something to worry about. China and the property situation, always something to think about. You could even go a little bit deeper and get into one of the things that we look at FBB is frankly looking at behavioral finance. So a lot of investors, a lot of complacency right now. You can even look at the markets this week. Not a whole lot of news. Markets are just gradually bubbling up, almost like looking at a fish tank. This bubble's just kind of moving on up on not a whole lot of news. So it could be something there. If investors just get a little too complacent into 22, you could see some volatility on the backside of that.
I want to turn to what it all means here for the market, though, of course, as we're watching what investors in limited volume here are making of the updates to wrap up 2021. And for more on that, I want to bring on Chad Oviatt, Huntington, a private bank director of investment management, joins us here. And Chad, appreciate you taking the time. I mean, when we're talking about wrapping things up and looking ahead to 2022, there's a couple stories that I'm sure are going to spill over. Obviously, inflation likely to continue for some time. Of course, the Fed expecting some of those pressures to abate by mid-year 2022. But talk to me about what you're expecting to see as we roll over into the next calendar year.
Yeah, thanks, Zach. Good morning. Thanks for having us on today. We'll follow on with what Anjali was talking about. Everything that we're thinking about is still very much dependent on the path of the pandemic. So we'll continue to watch that. Lots of headlines still to come on that, no doubt, as we continue to move through the pandemic. And moving beyond pandemic-related headlines, closing out this year, it was a really interesting year, a lot happening. As you mentioned, a lot of those headlines going to carry into next year as well. Think monetary policy, fiscal policy, inflation. But if you get beyond those headlines, as we look at the fundamentals, particularly the fundamentals here in the U.S., we think we start to get to some level of normalization in mid-2022 for both GDP as well as inflation. We think both of those probably end the year somewhere on an average of 3.5%. And so to us, we're really constructive on the U.S. equity markets, given that environment. Plus, when we go to the monetary policy side, we know that the taper is accelerating. We presume there are going to be rate hikes coming in 2022. We're forecasting 2 of those hikes. With those things going on, as mentioned, we do really favor U.S. equities heading into 2022.
Yeah, you got a lot of analysts out there, strategists, putting out their year-end targets for next year. And a lot of it seems like a bit everywhere, all across the board. And I'm sure a lot of the chop is expected to continue. When you look at the beginning of next year, though, as you said, a lot of people still focusing in on this latest wave. Fundstrat was out with an interesting chart kind of looking back at the latest peaks in hospitalizations when it comes to COVID infections here, pointing out that the market has bottomed about 12 days in each of these, that's the median, before the peaks in cases, and they kind of track out what things might look like with Omicron this time around based on what we saw in South Africa, the first region to really deal with Omicron. And they seem to predict that the market bottom is already in. So, I mean, when you look out in the short term to get things kicked off in 2022, would you be in the camp that says we are in the clear, that the Santa Claus rally could have already started here and we could be shaping up for some more strength? And if that is the case, I guess, which part of the market would you be leaning most into?
Yeah, great question. One of the things that we've been advising our clients about regarding particularly January as we head in, we've been telling Huntington clients that don't be surprised if we see some volatility in January, not just because of some of the headline risk that we're seeing, but because markets, particularly equity markets, did so well this year, it has a lot of portfolios out of balance. So we could see some rebalancing here early in the year that actually sees some selling in stocks, buying in bonds for no other reason than getting back into some of those policy targets that some of these institutional investors have, as well as some of the kind of programmed mutual fund type providers have where they're doing select allocations, call them 60-40, 70-30. Watch for some of that rebalancing to increase some of the volatility that we'll see in January.
Yeah, when we think about what's also planned from the Fed, it seems to be the biggest wild card factor for anything that's going to happen next year, just because you have some central bankers out there maybe moving in the opposite direction, particularly sparked by what we saw with Omicron, but obviously very difficult to plan out what happens in a pandemic. It's kind of been the tough job that Jay Powell has had all year in 2021. But when you look ahead, how poised are the markets to really absorb some of those interest rate hikes that people are predicting? 3, if you look at the Fed's latest projections, what that might mean when they start to go into effect, taking some of that help out, the juice out of the market when we think about what they have planned for next year.
Yeah, so when we think about the liquidity, again, the taper, so they're reducing some of their liquidity injection already. We know that's going to probably conclude right around March. We think about the rates increasing. What we have seen so far, though, is a large degree of transparency, a lot of telegraphing of what the expectations are, and markets appreciate that. They appreciate the transparency. When they know a little bit more about what's possible, then they can start to plan accordingly. There will be volatility, no doubt, but the markets in general already have some of these rate increases baked in. And in the last tightening cycles, those rate increasing cycles that we've seen, the equity markets have actually done pretty well. What we would suggest and what we've been telling our clients here at Huntington is get ready for active management to do well in 2022, because we don't think it's going to be a rising tide scenario like we saw this year. It'll be a case-by-case, company-by-company diagnosis of where the investment opportunities lie.
I guess before we let you go, I want to get your last call in terms of the stocks, too, that you would say are the best ones to really capture some of those upside. Which ones are you leaning into? Because it's been a weird year, and you might have some value names kind of limping across the finish lines where we did see kind of the rebound in some of those larger tech stocks to have it all kind of shake out in the Omicron sell-off. So which ones are you most confident in to get the year started?
Yeah, that's a challenging question given the year that we had. So what we've been saying is we've been investing in a post-recession type positioning in our clients' portfolios with an eye on inflation. So if you think about inflation, some things that come to mind to participate in an inflationary environment, small caps, real estate, precious metals haven't had the same historical relationship that they once did, but nevertheless could be a potential participant in inflation if that does continue through 2022. On the large cap equity side, where most investors, I think, focus their time and attention, large cap domestic equities, we're balanced. We're not choosing growth over value. We're thinking about individual balance sheets, quality companies, and making sure that we have representation across the board in most sectors so that when we do get some of these rotations, we get volatility, we know that we have somewhat insulated the portfolio around those items.
We want to keep more on the market right now. And for that, we're going to go to Octavio Morenzi. He is OPIMA CEO. And Octavio, glad to be here with you today. Just want to get your thoughts as we close out the year, what you're thinking about as we head into the new year, Fed, tapering, inflation, all that good stuff. How do you put it together and tell investors what you think will happen?
Well, I've been expecting, actually, with the Fed tapering its bond purchases, and I think most people have been expecting this somewhere along the line, to actually start to see interest rates start to creep up and 10-year yields and 30-year yields go higher as the Fed sort of cuts back on those bond purchases. That, of course, would be very, very bad for the equities markets, and I think would lead to some sort of correction. But I think the markets are now sort of calling the Fed's bluff a bit and saying, we don't believe you're really going to do it. We think you're going to carry on buying bonds at this rate, and you've had a bit of a taper, so you've slowed down slightly over the course of the past few weeks and months. But we think you're going to go right back to where you were, and Omicron is probably going to be the reason to do that. So we're starting to see rumors of an economic slowdown or certain sectors of the economy suffering as a result of Omicron and new shutdowns or shutdown lights coming into place and lockdowns. And that is sort of giving the Fed the ammunition to continue a very, very soft monetary policy, a very expansive monetary policy, which is going to be really good for markets. So we haven't seen the interest rates budge. And I think the reason for that is that markets, or the smart money, is basically saying, we don't believe the Fed is going to go there, really.
And I just want to get your reaction to, the CDC guidelines that now reduce the isolation time that's required for asymptomatic people with COVID. Is that something that's a positive for markets, particularly for hard-hit stocks like airlines who've just taken a beating, especially recently? And do you think to some degree that markets already pricing in that COVID, then now at some point turns into an endemic? It's going to be here for a long while we're still sort of seeing headlines in the news about it being a pandemic.
Well, I think the only thing that the markets are concerned, I shouldn't say the only thing, but the primary thing the markets are concerned about right now is the Fed's policy and what is the Fed going to do. And it's been these really low interest rates and this very expansive monetary policy that's driven markets to the highs that they're at the moment and continues to. So I think the market is assuming those things will continue. So yes, from an economic perspective, clearly it's better to have shorter recovery times or shorter quarantine times and isolation times so you can be more productive. So it certainly helps the real economy. But I think there's a bit of disconnect between the real economy and Wall Street at the moment that we're seeing quite clearly. And there has been throughout this shutdown and the lockdowns we've seen didn't really impact Wall Street at all. And markets just plowed through that, went to record highs without any real economic justification for that. So I think it's all about the Fed and what the Fed does and how much money the Fed pumps into these markets, either directly or indirectly. And in that case, perversely, bad news around Omicron might be good news for the market because it gives the Fed the impetus to continue with these very loose monetary policies. So I think too much good news for the real economy might actually be quite bad for the markets. And so you want to actually sort of find that middle ground somewhere. So obviously, if we have really hard shutdowns and the economy comes to a crashing halt as a result of Omicron, which I don't think will happen, but let's assume it did, that, of course, would be very bad for markets. But if it's sort of just in the middle, it's sort of an irritation more than anything else. Of course, if you're afflicted by it, it's much more than irritation. But if that is the case for the economy as a whole, it's an irritation, but it allows the Fed to continue these monetary policies, it's going to be very good for markets. And I think that's what we've seen over the course of the past few days. Basically, people say, well, if Omicron does rear its head, the Fed will carry on pumping money in, and that's going to lead us on to record highs day after day almost.
And Octavio, let's think about a different scenario. Notwithstanding your belief that the market kind of got ahead of the Fed, which I happen to agree with, but the Fed has gotten caught behind the eight ball many times in the past and has had to play catch up with inflation, sometimes worse than others. The early 80s are a memory as well, though I don't think we're going to repeat that. What happens if the Fed simply loses control over inflation next year and finds itself having to hike rates a little bit aggressively?
Well, I think what we'll see then is the market will crash. There'll be a severe market reaction, then it will come tumbling down. The markets, equities markets and bond markets will be a very bad place to be. The smart money will then be in absolute cash in very, very short-term money market instruments or actually just bank deposits or something like that. I don't think any asset class will be spared there because most asset classes, including things like cryptocurrencies and real estate and all this, are basically dependent on Fed largesse. So that is really what the driving force is there. So if we do see those kind of interest rates jacked up the way we did see in the early 1980s, we'll see a sharp market correction and interest rates really go through the roof. So I think interest rates in the early 80s went up to 15, 16, even as high as 20%, depending on which bonds you were looking at. So if you've been really clever back then in the early 80s, you would have sold your equities positions and put everything into government bonds when they were yielding about 15, 16%. And as those yields came down in subsequent years, you would have seen the value of your bonds go through the roof. I think something like that might play out again. So if we see interest rates go really high, and I don't think the Fed will do this, I think they'll be very reluctant about doing it. But if they're really forced, if inflation goes up above 10% or something like that, their hand will be played and they'll have to do it. And then watch the markets crash and jump into bonds. But timing that is going to be fiendishly difficult, I think.
Well, let's bring it back to the here and now. And, when yields do presumably move, as you say, they're stuck right now. We're, 1.4, below 1.5%. When they do cross 2%, hopefully sometime next year, is it a shot higher? Is it very quick like we saw at the beginning of this year? Or does that happen more gradually, do you think? And what does that mean for equities?
Well, I think the Fed will control that. So they have basically absolute control over how quickly interest rates shoot up or go sideways or what they do. So they can control that quite finely with their bond purchases, and they can keep an eye on that. And so I don't think they'll let it shoot and get ahead of them too quickly. They look for a gradual increase up to 2%, 2.5%, maybe back up to 3 or 4% that we've seen more historically in terms of the 10-year yield. So I think they'll do that slowly and gradually and not try to spook the markets. And they have the tools at their disposal to do that. So I don't expect to see a sudden burst up to 3 or 4% in terms of the yields on the 10-year bond. That will happen gradually. And that's the way the Fed was going to want to play it.
But first, we have to start with oil as prices are climbing back toward $80 a barrel alongside the rally in stock prices. Will the momentum continue into the new year? Phil Striebel is the chief market strategist at Blue Line Futures and joins us now. Phil, always nice to see you here. So what's the hot trade? Do you stay long oil into the new year?
Yeah, I mean, one thing you got to note with oil is that coming into pre-pandemic, the oil volatility was trading right in the 20s. That's measured by the OVX. Since we had the pandemic initially start, it shot up to over 500. Since then, oil volatility has been traveling right between 40 and 80. So you're going to see these movements that are 2, 3, even 4 times bigger than what are normally expected. So in the short term, we do expect this reaction from this new variant, which has caused thousands of flights to be canceled. A lot of these, people going back to work, they're back sheltered at home. So we are going to see a temporary hit on demand. We think prices could come back down to the 60s before starting a long-term rally in 2022.
Hey, Phil, it's Julie. So what's going to support that rally? Is it going to be a resumption of demand coming from around the globe? And what are we going to see on the supply side also?
It's a combination of the two. So we are going to see the demand picture continue to pick up going into the driving season, into the summer months. Hopefully we can get this pandemic behind us. You'll see all that pent up, travel demand really take back off again. Flights, they were pretty full over the weekend, but we expect them to get, even fuller as we come on, as the capacity picks up. Now, if you look at the supply side on crude oil, we have 423 million barrels for the EIA. The 5-year average is 460. So supplies are quite tight. We don't expect OPEC to take any kind of reaction by picking up, their supply picture. So we expect any kind of small supply shock would send prices higher. We are expecting $85 to $90 next year.
Phil, if one is bullish on oil, what's the trade? How do you play it? Do you go through an oil-exposed ETF? Do you go through individual stock prices? Is there an option strategy you should look at?
So the way we trade it is on the futures contract. And a unique situation with crude oil is that it's in backwardation. So the farther out you go, the cheaper the prices are. So what we're expecting is if you do get that pullback into the 60s on the front month, if you see it print on Yahoo Finance, look at the December contract because it's going to be right around $60. I think that's your long-term play. You buy the December 2022 crude oil contract as close to $60 as possible and hold for that move on up to $85, $90.
And Phil, all of what you're saying, I mean, if you're not somebody who actually trades oil, but somebody who buys it in the form of gasoline, like so many of us do, what you're saying seems to imply we're going to see higher gasoline prices next year.
No question about it. And, it's really unique how gasoline prices are. It's the way it flows, through the United States, up from the Gulf. And as you have supply chain issues, you see higher gasoline prices. And then also some of the states that have higher taxes, like when I go back to Chicago, prices are north of $4. When I get into Alabama, prices are $2.85. So a lot of it has to do with the political side of things, with the taxation on gasoline as well.
And at a time when gasoline prices are trending higher or may continue to trend higher next year, people are also paying more for their heating, right? I mean, natural gas prices, like forget about the volatility in oil, natural gas volatility has been crazy. I don't even know how to describe it.
Yeah, natural gas is up 60% as well in 2022, and gasoline prices. So they all have, spectacular gains. We are looking for a tactical entry on natural gas. Prices have come down since it seemed like it was, peak hysteria with Europe. Their supply situation is much tighter than the United States. So we are looking, though. We've had an extremely mild winter so far. We do expect January and February to be, unseasonably colder than what are normally looking at right now. So we expect natural gas prices to bottom here the next week or two and then take back off to the upside.
And so let's get back to the markets here and check in a little bit more on what's currently, in front of us here. And that, of course, has been this rebound, the relief rally off of, despite the fact that COVID cases seem to be getting worse. I think investors looking past it to the other side, maybe focusing in on hospitalizations, not necessarily surging as much. As we said, the Dow racking in 6 straight days of gains. For more on where we go from here, maybe how that story plays out in 2022, I want to bring on Sean Snyder, a Citi US Wealth Management Head of Investing Strategy, back with us. And Sean, good to chat with you again today, my friend. I mean, when we're looking at this, I think there is a bit of optimism, maybe that, the fears haven't lived up to the storyline, that maybe Omicron isn't as bad as initially feared when we saw the cases rising in South Africa. But I mean, how does that maybe change the story in terms of how investors should be allocating for next year, as we've seen this kind of rotation out of tech stocks back into value names maybe start to churn again? What are you looking at?
Right. So, when I think of a lot of the Omicron news, it's really early days still. It's hard to say you're optimistic about Omicron, right? But I do think some of the initial data is maybe making investors a bit more comfortable that this is probably transitory. And the reason they say that is if you look at early studies out of South Africa, the hospitalization rate for the Omicron variant is 1.9% versus Delta, which was almost 19%, so significantly higher. There's also some early reports that maybe if you do get infected by Omicron, that it provides protection against Delta, which we think is probably the more severe variant in the sense that it creates more illness and death. So, those things are positive, I guess. I mean, it's hard to say they're positive, but it's from an investor perspective, it's maybe positive that this is not as severe as we originally thought. As far as what it means for investors and how to think about the year ahead, you guys mentioned it earlier about some of these riskier assets maybe taking a bit of a leg down, and we're actually seeing that. We're seeing a rotation into what we would call long-term leaders. So healthcare stocks, consumer staple stocks are actually up about 9% since the start of December. So we're actually seeing people move into those types of trades and more things that would do better over the long run, less tied to liquidity and Fed actions and stimulus.
Hey, Sean, Brian Chung here. So let's kind of dive a little bit deeper into that. If it is indeed the Fed that might be the bigger story here next year, then we do know that the composition of the Fed will change with those nominees coming from the Biden administration, with new FOMC voters coming in that might have a hawkish tilt from Kansas City, Cleveland, and Boston. What do you think that says about the trajectory of markets? Should people be a little bit kind of on the sidelines as they figure out where the Fed's going to head, at least in those first few meetings this year or next year?
I don't think they should be on the sidelines. And the reason I say that is we actually looked at the data of what happens to the S&P 500 during Fed tightening cycles. And you can actually split it out into 2 categories. You can have a slow Fed tightening cycle, which is 6 rate hikes or less during the first year, or a fast tightening cycle. And the fast tightening cycle is 6 rate hikes or more during the first year. And we're projecting 3 rate hikes next year. So thinking this is a slow tightening cycle. And during slow tightening cycle, we look back the last 10 Fed tightening cycles. During the slow tightening cycles, the S&P 500 returned about 9%. During a fast tightening cycle, it was flat. So I think we're looking at a slow tightening cycle. I think that's the most important aspect of what the Fed's going to do next year. And I think history suggests that the markets can move higher as long as the Fed moves slowly. And I don't think they want to kill off this economic expansion. So I think they will do that.
And perhaps reiterating the point that normally when we see rate hikes, it comes when the economy is on good footing. And that is the hope that will continue over in 2022. When you look at the sectors that you're continuing to look at, maybe you could say, it would be surprising to see technology in there when we're thinking about a rising rate environment. But you got technology, healthcare, consumer staples as the ones you're watching, particularly with an emphasis on dividend growth. And we had a few guests this week talking about dividends being a huge swing factor for next year. Talking about why those are the sectors you like, and maybe, I guess, too, and again, because you can never really drill the point home enough, why dividends are going to be important.
Well, I think the most important point to remember here is that we've seen cyclicals rally quite a bit. And the reason is because they're rebounding from that beatdown they took in 2020, right? So a lot of those sectors that were most beaten down have largely recovered, or if they haven't fully recovered, they're close to full recovery. So we're looking at the sectors that haven't quite done as well or seen that strong of a rebound. And healthcare, consumer staples are ones that kind of lag behind, but now they'll go through what we think is a period of catch up. So what happens is when you transition to more a mid-cycle phase, you want to look at companies like healthcare, consumer staples, strong revenue growth, strong earnings growth, and less tied to the cyclicality of the economy. So we think those sectors will do well. We call them their long-term leaders. So far, they've been doing quite well since the beginning of December. We expect that to continue. And the other thing I would say about consumer staples to factor in is if you want to beat the cash thief or inflation, you want to look at companies that have strong pricing power and the ability to pass on those costs to consumers. Consumer staples and healthcare and technology are three of those sectors that can do that.
And when you talk about cyclicals, I mean, maybe some of that is just trying to hedge against near-term trends. But when you look longer-term trends, I've noted in your note that you sent along to us that you're looking at these unstoppable trends like cybersecurity. Can you expand a little bit more on what might be a better long-term play from a secular standpoint?
Right. So unstoppable trends is essentially things that we think play out over the next decade. So cybersecurity, digitization, data is essentially the new oil. Any of those types of trends, robotics, automation, those are things that we don't think are necessarily tied to the ups and downs or some of the market noise that we see in any given year. For example, at the midterm elections this year, that's not going to be relevant to those trends. So we think it's good to focus on things that are going to be long-term leaders, things that will help you beat the cash thief, things that will be a play for the next decade and not tied to the daily ups and downs of the market as much.
All right, the Biden administration's $1.2 billion infrastructure bill could prove to be a tailwind to investors in the municipal bond market next year. Jennifer Johnson is a senior vice president and director of research for Franklin Templeton's Municipal Bond Group. Jennifer, nice to see you here. So talk us through this. How are you positioned as this bill starts to take hold throughout the economy?
Sure. So we view this bill as a positive for the municipal market, and that is both in terms of perhaps supply as well as credit. And what this is going to allow is just infrastructure to improve across the country, which lowers costs over the long term to maintain that infrastructure. And then now we can have an additional source of money to fund projects either that may already be in the works or could be things that communities couldn't have done previously. So we do expect there to be a positive influence. We're not going to see a ton of debt issued right off the bat. This money is going to come in over 5 years. And these programs also take quite a bit of time to get actual shovels into the ground. So we don't expect a lot to happen in the next year, maybe some grant anticipation notes from an issuance side, but we do expect it to be positive over the longer term.
And Jennifer, it's Julie here. So give us a little more detail on the opportunities, the kind of opportunities this is going to present to muni investors and how they should be evaluating those opportunities.
Sure. So we don't have a lot of detail yet on exactly who's going to do what or how the money is actually going to come in. Usually funds are done on a matching basis. So the federal government will match whatever a state, local government, or transit agency is already spending. So what that'll do is improve those credits because it's taking some of that debt off the balance sheet of the state and local governments or transit agencies and transferring it to the federal government. So that should make financials look a little bit stronger, in addition to just repairing and bringing infrastructure up to speed. So we should see an improvement on credit. And then we should also see some increased supply. Again, not probably off the bat, but over 5 years. Now, who issues that and how it comes, that's what we don't know yet, but we would expect that the municipal market will play a role. The municipal market funds most infrastructure in this country. And so we think we'll play a large role in that.
Jennifer, how is the pandemic, the ongoing pandemic, I should say, impacting the municipal bond market right now?
Sure. Well, I mean, what a difference it's been over the last year and a half. State and local governments primarily receive tax revenue. So when you pay sales taxes, when you pay income taxes, or if you pay the toll at your local tollway. So all of those sources of revenue tightened up when the economy closed, people got laid off, people stopped going to stores and traveling and all of that sort of thing. Now, fortunately, we have seen a couple positive things happen. First, we saw state and local governments actually exhibit some really strong governance and management. We saw good financial policies, good financial decisions, which really showed that they were conservative in trying to approach how to manage this crisis. And then the second thing, of course, is multiple rounds of federal aid, which came in two primary portions, either a repayment for additional costs around COVID, so that there was no out of pocket for the state and local governments. And then in some cases, actual revenue replacement money for things that weren't getting financed, things like people not riding the subway, people not having elective surgery. So that federal money was certainly crucial for those credits. As we're looking at it now, economies were reopening over the summer. We saw, some good rebounds in tourism. That slows as we come into the winter months. And of course, now we have Omicron. And so we're watching carefully to see what the impact of that is going to be over the medium and longer term. We think that state and local governments, as well as municipal agencies, are in a really good position, thanks to the federal aid, thanks to the conservative management and governance during the crisis. So we're optimistic that they'll be able to manage any more bumps along the way from Omicron or whatever might come next.
One of the things that we know is coming next, probably, most likely, in 2022 is an increase in interest rates from the Federal Reserve, right? That's something that they've telegraphed. What kind of effect do you expect that to have on the muni market?
Sure. Well, we definitely follow higher interest rates. And, of course, there's the impact on credit, which means higher borrowing costs for local governments. Rates have been at all-time lows. So, certainly anything is going to seem more expensive to a local government, but, relatively, it's not as much of an issue. But what's actually more important for us is not necessarily federal interest rates, but how the muni market matches up against that. And we want to look at how munis trade to treasuries at both the high grade level as well as down the credit spectrum. And, right now we feel pretty good about things. We think there's fair valuations at the high grade level. And there's definitely opportunities for spread as you move down the credit spectrum. Spreads have tightened as, as states and local governments have come out of the COVID crisis, but there's still availability in there to find, great opportunities for spread. And we have a deep and experienced research bench. And that's what that team does all day is look for those opportunities where we can add value with spread.
Gotcha. Interesting stuff. And then finally, I want to ask you a little bit about ETFs, muni ETFs. That's because there was a story recently in the Journal about how we have seen a lot of the incoming flows to muni bonds go into ETFs versus more sort of traditional funds. And you're on the fund side of the business, as I understand it. How is there an effect on the overall business from this phenomenon? Certainly, we've seen it happening in other types of asset classes, right?
Yeah, I think from our perspective, whether we're managing assets for an ETF, managing assets for a traditional long-term fund, intermediate fund, whatever, we're going to approach it the same way. We're looking for value, we're looking for spread, we're looking for appropriate prices and valuations on the credits that we're adding, and then whatever appropriate credit risk, given what the portfolio might be aimed at. So from the perspective of having more money coming in, it just gives us an opportunity to do more money management. So from our perspective, managing the money, we're going to think about it differently, but it's still the same, municipal product in our minds.
We want to continue the markets discussion and bring in Tom Essay of the Sevens Report. And Tom, I'm just, it's a quiet day, admittedly, it's a quiet week, but a lot to think about for investors as we head into the new year. Just wondering what you're making of the rally that we've seen over the last 5-6 days here and what you're looking for in the new year.
Hi, Jared, and Happy New Year, everyone. Thank you for having me on. Typical year-end quiet trading for sure. I wouldn't read too much into this week's rally, honestly. I mean, there's very strong positive seasonals. There's nothing really, unless we get a total surprise from Omicron here in the next couple of days, that would really derail the drift higher into the end of the year. But here's the thing: don't let the strong finish fool you and make you think that 2022 is going to be another year of near 30% returns and almost no volatility. There is a major change coming next year, and it is that global central banks, not just the Fed, but global central banks, are removing accommodation, and they could do it pretty quickly. So we've got rate hikes and we've got tapering of QE coming, and that is going to mean more volatility, and we should all be prepared for that.
And then on the flip side of that, you see the PBOC injecting cash to help, shore up the economy at the end of the year. We all know that China's economy is slowing a little bit. And what impact do you think what happens over there affects us over here, particularly since we do have this news that Samsung's productions in China have been, their production schedules have changed due to this threat of Omicron that is spreading in one of their key industrial cities there?
Well, I think that China, the Chinese central bank essentially stimulating the economy is a general positive for global growth as we start 2022. What China does matters to the global economy, certainly, and the fact that we can get their economy kind of revving again, that's something positive for all risk assets. I don't expect that it's going to happen early in 2022, but we do think that China is a very interesting contrarian play for 2022, specifically something like KWEB or one of the other China-focused ETFs. More broadly, Omicron is really changing the game a bit on COVID. I mean, we are going to see cases absolutely skyrocket in this country here in the next week or two. I mean, we should easily double the previous high that we had of about 300,000 cases in the next couple of weeks. The issue there is, what does it do to supply chains and what does it do to inflation? To your point, if we all of a sudden have semiconductor chips, roofing again, essentially, then is that going to only further increase inflation and make the Fed more hawkish? These are a lot of things we got to think about when 2022 starts, although thankfully we get a few more days to relax.
And Tom, I promised the viewers I'd get into the bond market before, so I want to bring up the Wi-Fi Interactive. We have the 5-year T-note yield up about 5 basis points right now. And just on a technical basis, you could make the argument it's kind of broken to the upside right here just a little bit. Here's a 10-year T-note yield broken through this high from early December. And then the 30-year advancing as well within its trend channel. And all of this is pointing to an expanding yield curve. And we're seeing that value trade outperform today. I'm just wondering, so we're kind of discounting the moves in the equities markets. Do you see anything here in the bond market that we should be paying attention to, Tom?
Well, I think it's interesting that yields are a bit higher today. They're popping a bit. I think part of that was the fact that oil was higher on the inventory number, but we also have a lot of year-end positioning going on, right? So if we think about what's happened with bonds, especially in this recent fourth quarter, obviously you've seen bonds higher, yields lower. And what you can typically tend to see happen at the end of the year is people sort of close out those trades. Now, looking forward into 2022, if you're talking about a 10-year that's, sub 1.5%, which is essentially just where we are right now, if you like yields there, then you have to be of the opinion that we are not going to see continued strong economic growth in 2022. That's definitely not consensus right now. And I think that if we are going to see better growth and we are going to see higher inflation, which is our opinion, then you are going to see yields rise. They're not going to rise as quickly as sort of everybody would expect because there are a lot of international influences. But at the same time, I would be a buyer of yields here. I still think we hit 2%. We would have hit 2% this year if not for Omicron. I think we can hit 2% in early 2022.
Everyone's waiting to see that when it happens. Look, you touched on some of the things that could go wrong in 2022. The Fed may have a big part to play in that. But what are some of the things that you think that will go right next year?
Sure. I think that essentially a continuation of what we have this year, right, where a lot of the things we were worried about from a macro standpoint never actually happened. Earnings continued to get better and better. Earnings expectations continued to grow. I mean, one of the biggest takeaways from the whole pandemic is that corporate America is incredibly flexible and incredibly resilient. That's got to make everybody who owns U.S. stocks feel really good. I think that can continue in 2022. Additionally, if we could see inflation peak and begin to back off, that's a huge tailwind. It doesn't have to go down to 2%, but if we can just get it to back off, then that will let the Fed be a little more patient, and it'll take pressure off of earnings. So really just a continuation of what we've seen. And then, of course, it certainly would be nice if this pandemic could finally burn itself out and we don't have to deal with wave after wave, variant after variant.
And the direction of the U.S. dollar. Christopher Vecchio is a senior strategist at dailyfx.com and joins us now. Chris, Happy New Year to you. As Julie mentioned at the top of the show, it has been a pretty decent year for the dollar. What's your outlook for next year?
It looks like that the dollar still has a chance to further its gains as we head into early 2022, in part because of the juxtaposition between Fed policy and the policy of other major central banks, mainly the European Central Bank and the Bank of Japan. Rates markets have pulled forward rate hike expectations to March 2022 for the first rate hike per Fed funds futures. But we've seen both a hawkish and a dovish twist in a sense whereby the market's now saying, yes, we'll get rate hikes sooner. And as a result, we may need fewer rate hikes for the Fed to accomplish its goals. So right now, the dollar index, it's been consolidating over the last few weeks. Not surprised as it works off the longest net long position in the futures market since October 2019. Historically speaking, December hasn't been a great month for the U.S. dollar. But as the calendar turns into 2022, we do think that the dollar still has more upside from here, looking at that 100 handle before June 2022.
Oh, wow. And what does the trajectory of the dollar tend to look like once the Fed actually starts raising rates?
So it really depends on the relative position of Fed policy compared to other central banks. But importantly, right now, the dollar still has this 2-5-10 butterfly that's widening. And historically speaking, as you look back into the QE era of the 2010s, that was actually good for greenback strength. So early on, the first few rate hikes can be good. It's when you get into the second half of the rate hike cycle that they tend not to have the same type of positive impact for the U.S. dollar. As by and large, that's expected. It's priced in. And moreover, as the Fed rate hike cycle matures, other central banks begin to play catch up.
And Chris, do you see any wild swings in international currencies once the Fed does start hiking rates?
Sure. I think emerging markets right now are very vulnerable. I think that when you look at a country like Turkey, for example, even if they've implemented some of these measures to shy away from speculation among domestic currency holders, it's really going to put a lot of pressure on their fiscal position. It looks like Turkey's burned through a significant portion of their foreign assets over the past 2 weeks to prop up the value of the lira. Even though the Turkish lira rallied by 50% last week, it's still down over 40% year to date versus the US dollar. Same situation against the euro. And so I see a Turkish lira, I see a South African rand, a lot of pressure there as external financing conditions become more and more difficult for these emerging market currencies, not dissimilar from what we've seen during previous Fed hiking cycles.
You know, I want to ask a little bit more about the Turkish lira because it has been such, I mean, you know, we saw this a couple of years ago, right? And now seeing this again, this just wild move in the Turkish lira. And you talked a little bit about it in the broader context of emerging markets, but how are we to view, particularly those of us who are not currency traders, how are we to view the Turkish situation? Like, is there a sort of bigger takeaway, or is this story just kind of a curiosity?
No, this is a full-blown currency crisis. They have rising external debt, wide bond premiums, rising inflation expectations, record low real yields. I mean, they check every single box in the textbook for an emerging market currency in crisis. So this is a situation that's going to get worse before it gets better. For some reason, Turkish President Recep Erdogan has this fascination with the notion that lower interest rates will not lead to higher inflation. That's news to mostly anyone in macroeconomics. I certainly haven't read that in any textbook. Don't recall reading that during the CFA charter studies. But good luck to him. I think it's going to cost a lot of social capital there. I think that there's more and more political pressure in Turkey, and the central bank has lost any semblance of independence under Governor Kavsioglu, if I'm pronouncing that correctly.
Yeah, I think you're right, Chris. I don't think you'll find any of that stuff in those CFA giant books. But look, interesting, we've seen a recent push higher in the dollar, and at the same time, Bitcoin prices have been under pressure there. Is any correlation?
I don't really think so. Bitcoin prices have been falling across the board against a number of major currencies, in part because we're starting to see the creep in of the expectation that liquidity conditions will become a little bit more difficult henceforth. Listen, 2021 was a banner year for stimulus. We had rising fiscal deficits around the world. We had monetary policy that was still incredibly stimulative. But when you look forward down the line, in the UK, for example, austerity already appears to be underway. In the US, we're having questions over the Build Back Better program. We have the Fed on the verge of a hiking cycle, And then when you look further into 2022, the midterms are right around the corner. And as things stand right now, it doesn't look like Democrats will retain control of the House, of the Senate, which means we could be back in a situation like we were in the early 2010s when we had a Democrat in the White House, Republicans controlling both houses of Congress. And ultimately, that means potentially less deficit spending. So risk impulses are starting to turn the corner. I think actually one of the reasons why when we get this question, do you see any meme stocks or altcoins performing well in 2022? That speculative fervor may die down to a certain extent as the year goes on.
So what does that mean specifically for Bitcoin then as well? Or if we broaden out and say cryptocurrencies more broadly, do you have a Bitcoin target, for example? Do you think institutions who may have been selling at the end of this year are going to come back in January?
So what we've noticed over the course of 2021 is that on-chain transactions and the number of active wallets have actually fallen little by little over the course of the year. They peaked right around the GameStop and AMC frenzy in early January, February. And so it does look like Bitcoin could have a little bit more downside from here, perhaps down to 42,000 once more. Again, the lows that were tested in early December. But I think that Bitcoin and the broader cryptocurrency market is going through a moment of reflection here, a bit of a crisis of faith right now, because for much of this year, we've heard all these thought leaders, all these individuals who have been right about their Bitcoin prognostications in the past, telling us that we're going to get to 100,000 by year end. Now, technically, that's still possible. I guess there are, 15 hours left in this year. So I can't say 100,000 is out of the question, but I think it's really unlikely. And so a lot of these people who have been, more or less the flag leaders standing at the front of the marching band, they now look wrong. And this could cause some individuals who have jumped into the market late to question whether or not they should continue to participate. They didn't get the gains that they were seeking. Ultimately, I do think there's a little bit of a sentiment letdown right now in cryptocurrency. So further unwind from here wouldn't be a surprise, but Bitcoin likely to be the least impacted during this unwind. It's those secondary and tertiary, the derivative altcoins, meme coins, if you want to call them that. Those are the ones that will see deeper and deeper losses. I'd be very surprised if Dogecoin and Shiba Inu have a good year unless someone like Elon Musk is pumping them on Twitter.
Wrapping up 2021 and also looking ahead to 2022. We're going to do the latter with our old friend Sam Rowe, editor of Ticker.co. And he has been looking at some of the big market themes to watch going ahead to 2022. Sam, welcome back. We want to look, first of all, as you did, at earnings, because earnings I think it's safe to say that a number of different metrics in 2021 were better than expected. We tend to see analysts sort of lowball these sorts of things, but nonetheless, earnings have been doing really, really well. So I guess one of the big questions that you're asking here is, will they continue to do as well?
Yeah, no, 2021, this whole pandemic period has just been really crazy in that everything has been very difficult to model. And that's what every single one of these analysts, and then you ask the strategists too, is there's, all these models are so sensitive to all these different inputs that whatever it spits out, whether it's 10% earnings growth or 30% earnings growth, there's always this wide margin of error. Not to mention the fact that, so many of these inputs are, unpredictable. And I think one of the more interesting periods from 2021 was Q3, where and even early Q4, where everyone was trying to understand the impact of the Delta wave of the coronavirus. And yes, there was an incredibly terrible variant of this virus, but people were out there shopping and corporations were raising prices and profit margins were getting fatter, and earnings crushed estimates, yet again, as it often does. And so that's basically kind of the setup going into 2022, right? So 2021, based off of the estimates so far and all the incoming data that we've already had, earnings are estimated to have grown 45% year over year since 2020. Now, 2020 has kind of a low base, but 45% is still pretty extraordinary. And going into 2022, all these strategists who are forecasting where the stock market is headed, on average, are forecasting about 9% earnings growth for next year. So, if when you consider it relative to 45% growth in 2021, 9% seems kind of ambitious. But, when you consider the long history of the stock market and earnings growth, 9% ends up becoming, pretty average. So, the question ranges from everything to, is the bar set too high? Is it just right? Or, are we going to find out that, a lot of the things that we talked about last week, right? All these sort of signs of pent-up demand in the economy, is that going to translate to something that leads to even better earnings than what's currently being projected for 2022?
And Sam, I love me some gross profit margin calculations, but you, my friend, are looking at net profit margins next year.
Yeah, I mean, net profit margin, operating profit margin, gross profit margin, right? So, gross profit margin, Brian, that's sort of the starting point, right? Like what are costs going to look like? What are input costs going to look like for companies going into 2022? And, if it is the case that supply chains start to ease up and, actions from the Fed or whatever lead to a situation where input costs start to come down and, all these inflation metrics start to come down, then, gross margins could potentially expand. Not to mention the fact, and then, if you go further down the income statement, I don't know how wonky we want to get here, but I like your setup, Brian. If we want to talk about, operating profit margins, so after all those input costs, you talk about all the various fixed costs that a business has, like, the leasing of office space or ongoing salaries for, the finance department or whatever. If there is going to be some sales growth, like we were talking about just before, if demand is going to continue to increase and sales is growing based off of fixed cost structure, then yeah, you can get some more improvements in operating profit margin just because companies are producing more with their existing infrastructure. And but yeah, the forecast that you see in the chart, is net profit margin, and so that also incorporates things like interest costs, interest expenses, and taxes. And this sort of relates to the third item in 2022 market themes. What happens with interest rates? Because of course, interest rates is something that's going to factor into things like interest expenses and interest costs. And yeah, it's going to have to do with what happens with interest rates in 2022. And, I think we were talking, you guys were talking about this in an earlier segment. The forecasters out there are predicting long-term interest rates to rise. Like, I think the 10-year yield is somewhere around, 1.5% right now. But, there's an expectation that that's going to start to grow to 2% and even potentially higher. So that's going to be an interesting one to watch because, of course, when interest rates rise, it's not just, the cost of borrowing for corporations, but it's the cost of borrowing for everybody. And that has a potential to ripple through the economy.
Although as one of the other charts that you have shows stocks still traditionally have gone up after rate hikes. Finally, let's talk valuations for a sec, Sam, because this has been a perennial topic, right, for the past several years where a lot of belly aching about high valuation, stocks priced to perfection, and then valuations just keep going up, or at least are elevated versus historical levels. So I guess that's one of the other lingering questions going into this year. Will this be the year finally that we see valuations start to come down in a more decided fashion?
Yeah, that's a great question. And this is the thing that's been driving investors and market forecasters, insane since, the beginning of the stock market. I think Brian even mentioned, in the earlier segment that, one of the things that, he's learning is that valuations can stay very high for a very long period of time. And yeah, that's exactly what we're learning. It's not just this past year, it's the year before and the year prior that, these valuation levels have been elevated. If we want to start to get into the sort of the math of it all, there is this kind of irony that happens when, if valuations do stay this high for long enough, these elevated valuation levels end up becoming the long-term average that it's being measured against. There's a lot of different sort of questions as to what happens here, including, what happens to interest rates, because, there is this, this thinking that low interest rates is one of the reasons that valuations have been elevated, because it justifies, a higher level of valuation for a number of reasons, including lower borrowing costs. But, when interest rates are really low, other kinds of securities that aren't stocks, that aren't equities, like bonds and credit and all these other more interest rate sensitive securities become a little bit more attractive, because, you get more yield, and suddenly, all right, well, it's a safer bet to invest in a bond that has a decent bond yield, as opposed to a stock where you're trying to get a dividend payment, but it's lower on the capital structure, all that good stuff. It's a big question. It's something that's always got people scratching their heads. But I think one thing that's really important to note, though, regardless of why whatever is driving valuations, it is possible for valuations, as measured by the PE ratios that we're talking about, it is possible for valuations to come down in a decided way without stocks going down, as long as earnings growth is outpacing stock prices, which is something that that happened in 2021. Remember, we started this segment talking about how earnings growth is up 45%, and this is a year where the stock market was up, about 30%. 30% is an extraordinary number, but 45% earnings growth is, actually a much higher pace of growth. And so this is why valuations have come down a little bit in 2021. So it's possible that we could get a repeat of that next year, where earnings growth outpace stock price growth, and valuations come down as prices are rising.